higher for longer sort of narrative is still very much in play.
Inflation has been high, and at some point that should weigh on activity. We probably do get some type of broader downturn in the economy.
I don't think there's a recession coming next year. It's just a gradual slowdown.
Highest conviction trade is no eases. Fed on hold till at least after the election.
It needs to be a pretty catastrophic crisis, I think, for them to be forced into really, really loosening policy.
This is Bloomberg Surveillance with Tom Keene, Jonathan Ferro, and Lisa Abramowicz.
We are thankful for one more trading day before the weekend. Gina Martin-Adams alongside me. Tom and John both have the day off today on this post-Thanksgiving day. Good morning. Welcome. This is Bloomberg Surveillance Live on Bloomberg TV and Radio. Gina Martin-Adams, I guess Tom would say, pulled the short straw to actually have to sit here post-Thanksgiving. How was your Thanksgiving?
It was great, thank you. How was yours?
It was good. What was your favorite meal? I actually did some research about what aspect of the meal people like best.
Oh, God.
What is sort of like always the highlight?
This is almost impossible for me to choose because I like all of it, but I really love the sides. My husband is a specialist in the side dishes, from the green bean casserole to the stuffing to all kinds of corn dishes and things. So all of the sides are wonderful. As much as I love a turkey, I love all the sides.
Well, yeah.
The variety in the sides.
So there was an Associated Press study that came out that showed that 3 in 10 people see the turkey as the highlight. I was sort of found that odd, but more than 20% thought that it was really the sides. Anyway, this is a morning that is slow, and a lot of people are going to be talking about what they talked about last night at the Thanksgiving dinner. They also will be shopping Black Friday. And Gina, you're the best person I could imagine having on to talk about how important it is to get a read on how much the consumer spending continues into the season.
Yeah, I think it's going to be really interesting because there are actually very, very low expectations for the consumer. And I think that this is something that is not oftentimes discussed. We're all worried about the consumer, but we've all been worried about the consumer for so long. So I actually think that what we need to realize with this season is how bad is it getting, not is it still good. And we can talk a lot more about that going forward, but I think that that's the psychology that's embedded in market prices is, oh gosh, is the consumer going to hold in there? We're so worried about the consumer, and we have been for quite some time. They keep sort of beating our low expectations bar.
Is it a good thing or a bad thing if people come out to take advantage of discounts today and for Cyber Monday?
Well, I think this is a really good question because to me, it's a good thing that they're shopping at all, considering expectations. And if they're shopping last week, this week, next week, they're shopping. They're still shopping. Because if you think about the broader landscape, there's no fantastic products that are making everybody run out and get them. There's no big fancy gadget, no new electronic device that everybody's got to have to stimulate them to go out. So that already sets the bar very, very low. They just need to shop at this point in time. And I know that that sounds crazy, but we've been in an environment where all they've been spending on anyway for the last year is really services. They've been pulling back on goods investment or goods spending at all. So if you do get consumers going out and buying a few TVs, a few electronic devices, and some of those holiday gifts, I do think that that will be enough to sort of sustain expectations. But will we get that is still a question to me.
Yeah, and although there is this feeling that maybe people just need to get out of the house after their meals last night and to avoid further conversation with their families, there is this issue. As we take a look today, there is good news, which is that there is this ceasefire that is starting between Hamas and Israel, and the hostage release of people who have been held by Hamas, as well as a prisoner release by Israel. There is a feeling, in my view, that markets have moved on from this story.
Okay.
Do you believe that, or do you think that people are still watching this? I know that on a personal level, everyone is watching and reading all of the developments. It is really embroiling a lot of people into active debate and a lot of anger. But from a market perspective, how much is there any kind of care? Because I don't see it reflected anywhere.
Right. No, I think that this is a really good point because markets always struggle to price some sort of geopolitical risk in general. And we didn't see a tremendous amount of market activity related to the war, even as it broke out. And the reason for that is because we did not see huge changes in commodity prices, nor inflation expectations, nor huge budget potential impacts as a result of this particular conflict. So I think that the market struggles to price it as it is. And so therefore it feels like it's a peripheral issue. That said, to the degree that you're feeling it, any trader is feeling it, any investor is feeling it, there is certainly some sort of depressed risk premium tolerance, right? A risk tolerance that I think continues to play out in markets. And this might be a little bit of relief from a risk intolerant kind of climate.
And we'll get more into that in a bit. I do want to just say we are seeing a pretty quiet market. People are kind of maybe admired in their tryptophan. At least if you look at the equity space, you could see up about 0.1% after the closure yesterday in the United States, 45.72. Again, kind of amazing, given some of the levels people were expecting to end the year. It is interesting to note the 10-year yield up almost 7 basis points. And this comes on some discussion from Germany about not sticking with their net zero debt incursion. And we can talk more about that coming up as well. What we're looking at today, 7 a.m., we're going to have an interview with Macy's CEO Jeff Jeanette. He's going to be joining Bloomberg Television with our own Caroline Hyde, who will be on the floor joining the shoppers. At 9:45 a.m., we get the S&P Global U.S. PMI data, taking a look at whether we start to see a softening on the services side. As Gina was saying, we really have seen the spending on the services side. How much do you start to see that wane? And then markets do close early. Stock market closes at 1 p.m. Bond market closes at 2 p.m. So for those who are stuck trading, at least there is a reprieve at the end of the tunnel and you can go crash afterwards. Joining us now is Steve Sosnick, Chief Strategist at Interactive Brokers, someone who has seen the different narrative shifts and the different swings of the market and the different kinds of technical underpinnings all year. I'm curious from you how much you think that this rally to risk has legs, how much the sort of holiday spirit can last.
Good morning, Lisa. It's one of these things that we can always, markets can always just move longer than they should or would or could, just because people, it's the old animal spirits argument, and I think we can see this across the board. The question to me is, how can it stay broad? How can we get beyond 7 stocks driving the narrative and onto a broader narrative?
Steve, when you look at the activity inside Interactive Brokers, I'm very curious as to what you're seeing with respect to traders and their general risk tolerance this year. I think we all know, you go back to 2021 and the meme stock craze was sort of peak activity, peak risk tolerance. But how do you see this year playing out relative to last year, and what do you think that means for 2024 going forward?
Few themes, are different. Certainly, short-term option trading has really been a game changer for a lot of the customers. We've always been an option trading focused firm, and they're certainly diving in full force into the so-called zero-dated options, the daily expirations on index options and ETFs. No one really traded S&P index options. No individuals used to do it. Now they do it all the time because they're cash settled and give you tremendous leverage. On the other hand, they also are the most likely options to expire, without any premium, of course, but that's a discussion for another time. They also tend to be very focused on their favorite names. I look at, the top names that they're trading all the time. It's always pretty much Tesla, NVIDIA, AMD, SQQQ, TQQQ. So they tend to be speculating. They tend to like their names and trade in and out. And they have been, on balance, accumulating those top names more than selling them off. But they haven't really been diving in whole hog recently. So it's definitely a bit of a speculation in the names you'd expect them to be speculating in, and a lot of two-sided trading, possibly even more than I expected, because they're not really they haven't been huge net buyers in this uptrend. They've just sort of been trading around their favorite positions.
Interesting. So this theme of concentration risk kind of continues to plague us, both from a trader perspective as well as a market perspective. What do you think are the catalysts that are likely to emerge to really shift that? What could we see emerge in the market that really improves the confidence and broadens out the trade beyond those favorite names, the top 7 in the S&P 500, or those sort of more selective trading?
I think we basically need to get into a sense where we need some clarity on the economy, one way or the other. And we need some, you were talking about consumer spending at the top of the hour. We need a lot of clarity in terms of consumer spending. We also, we just basically need to know, is this going to be a soft landing? Is the Fed going to be cutting rates? And if they are cutting rates, why will they be cutting rates? Because that's really a big bet that's being placed in the market, is somehow, we're going to get maybe a rate cut by May, certainly by June, another one by July. But why? The question is, under what circumstances is the Fed going to just be preemptively deciding real interest rates are too high? Are we going to have won the battle against inflation, the war against inflation, or are things going to be lousy? The problem is inherent in a lot of these bets about cutting rates is a very much of a careful what you wish for scenario. Do we want the sort of circumstances that will force the Fed to cut rates aggressively? Because every inclination that I see is for them to move very slowly. They're not going to come down at the pace that they went up, barring some sort of reason for them to do so. Without this clarity, it's very hard to sort of move away from the stuff that's working into the stuff that's more of a bit of a value hunt.
So what are you looking for, Steve, when it comes to sniffing out some sort of downturn in retail spending? We were talking, is it a good thing or bad thing if people are looking for discounts today when they go out? There is this issue of, is all spending good spending?
I think from an economic point of view, I guess so. I mean, I guess it's like empty calories versus healthy calories. I think if you're doing economic measures, it doesn't really matter. My perspective on Black Friday is possibly an odd one because my dad used to be a retail analyst before he retired, was a retail analyst covered the retail industry, and I used to have to go and sit and count bags on Black Friday sometimes for him.
You must be so grateful you don't have to do that today. Carry on.
I don't go anywhere near a store today as a result of that. But so it was always the metrics: are the parking lots crowded? Are the malls crowded? But his thing was make sure that people are buying things. And so I think it really doesn't matter too much in terms of how they're spending. I think it's just really a question of consumer confidence. Are they spending? Do they feel okay? We're in an interesting spot now where the vast majority of people who want jobs have them. That's what an unemployment rate with a 3 handle tells you, is that people who are the vast majority of people have the jobs that can afford that can allow them to go buy things. On the other hand, they've been tightening their wallets, they've been tightening their belts. It's kind of interesting, gasoline prices, which is a big driver of consumer sentiment and people's perceptions about inflation, have actually been coming down. But the narrative out there is still that this economy is not good, despite any evidence to the fact that it actually is okay, or actually quite good in many respects. So the question is, will the customers be slowing down their spending? I think we just want to see them spending. If the early sales that have been coming through my inbox are any indication, the retailers are nervous that customers won't. And as Gina alluded to earlier, let's see if they do, because let's see if the expectations are dire enough, so to speak.
Steve Sosnick of Interactive Brokers, thank you so much, and happy Thanksgiving. Thank you for being on this show with us this morning when most people are sleeping in. Gina, I do think about that, this idea that no one wants to be near a store on a day where there are incredible discounts and you are going to have massive hordes. I wonder how much it's going to move online, whether people just go to the stores to get out of the house, try something on, and then go home and order it online. Yeah, and also how much it gets spread out over time now that online is an option. Now that we have the option of not going to stores, it's permanently embedded after the pandemic experience. What is the reason really to get out and go to a store? You can get out and go to the park, you can get out and go to all kinds of other places. It doesn't have to be the store, because of the convenience of online shopping. And I think we do see the season generally spread out as a result. Did you ever line up outside of the store at I never did. 4 a.m.? I never did. 3:30 a.m.? No. I can't say that I was ever into this. I remember as a child when there were really key toys. Yeah. My mom making a huge effort to make sure that we got those toys, and I can remember her getting out and getting things done. Like Cabbage Patch Kids? Thankfully, exactly, Cabbage Patch Kids. I had the twin set. Oh my goodness, it was amazing, you did. Right? It was amazing. Buy a used one. So she did that on our behalf and for us, and I'm grateful. But I certainly never have had the chance to do so. Thank you to Gina Martin Adams' mom from New York. This is Bloomberg.
Hamas also took hostages in order to constrain and delay an Israeli ground campaign. The hope is that pressure will mount. A 4-day pause will turn into a 6, 7, 8, 10-day pause. Pressure will mount for what Hamas really wants, which is an extended and prolonged ceasefire.
And we seem to have gotten a pause, at least for now, as you do get the hostage release of Hamas to Israel. And there is this ceasefire, at least temporarily for the moment. That was Aaron David Miller of the Carnegie Endowment for International Peace speaking with us on Wednesday. A real question here of what actually is transpiring while there is this temporary pause in fighting, and how likely it is that it actually can extend into either a prolonged ceasefire or a prolonged resolution in some capacity that could create an end to a lot of the suffering. Bobby Ghosh joining us now, Bloomberg opinion editor. And Bobby, I want to start there. How do you understand what this is? Whether it's a pause, whether it's a temporary ceasefire, whatever language you want to place around this?
I suppose you could say this is a cessation of hostilities. It matches the definition of a truce. Both sides have agreed in the middle of the conflict to stop shooting at each other, allowing some humanitarian effort to take place, and an exchange of hostages from one side, prisoners from the other. It meets the definition of a truce, and it's only meant to last for 4 days. Israel has been signaling right from the start that it's not interested in a longer duration at this point, that 4 days is what it'll allow. And then Benjamin Netanyahu, the prime minister, has said it'll resume the war until, by its definition, Hamas has been completely destroyed. There has been some talk that the truce could be postponed day by day if Hamas continues to release more hostages. But then there are military calculations that Israel would have to make. Clearly, Israel feels that 4 days is a good enough time to extract some hostages without giving Hamas the breathing room to rebuild its sort of depleted weapons, to regroup, to reorganize its forces, and represent a greater level of danger. Whether that will still be the calculation on day 5, day 6, day 7, we'll have to see.
Do we have a sense, Bobby, of just what kind of progress the Israeli military has made, of exactly how far they are in their goal?
Well, the goal is so vague that it's hard to tell. Destroy Hamas is a very sort of impossible thing to calculate, because we're not talking about a traditional military force. This is a terrorist group that lives within a civilian population. Israel has surrounded Gaza City, so the northern part of the Gaza Strip. It has destroyed vast proportions of Gaza City. It has told the Palestinians who are living there to go south to the southern part of the Gaza Strip. But now it feels that, and this should have been predictable, that some of the Hamas leadership and many of the fighters traveled with the Israelis who were, Palestinians who went to the south. So now what do? You can't tell the people who are in the south to keep going, because the Egyptians beyond the south won't have them. It has now designated a smaller strip of land along the Mediterranean coast, about 2.5 square miles, saying that people should go there. But of course, a lot of Hamas people will go as well. So what do you mean by destroying Hamas? And if the goal cannot be defined, then it's almost impossible to say how far they have succeeded in that goal.
Bobby, can you give us a deeper sense of the hostages that will be released, and who are they? How many are there? What nationality? Where will they go? Where will they go to seek refuge and or potential permanent residence?
Well, 50 hostages is the number we are hearing, women and children, all of them. Some foreign nationals, but not very many. Most of these are Israelis. And on the other side, Israel will be releasing 150 people that it has in its Palestinians that it has in its prisons. Israel says that these will all be women or children or juveniles, people below the age, boys below the age of 18. Those are the terms at the moment.
And what is the temperature of the surrounding nations with respect to this temporary ceasefire and the hostage release? If you could characterize, how is Egypt reacting? All the different nations who have taken on some refugees from the turmoil, what is their temperature right now? Well,
the relief, I suppose, even if it's temporary relief, any cessation of hostilities means that those Palestinians, ordinary civilians, innocent, not participants in any of the terrorist activities, that those people will get at least a little bit of a break, and that humanitarian supplies can now be accelerated into the Gaza Strip particularly from Egypt. So there's temporary relief, but I don't think that they're going to be satisfied with a 4-day pause, because if all this does is allows some people to be released from both sides and then hostilities return to where they were, then the neighbors are not going to feel particularly good about it. They've been asking for a ceasefire, which is, I think, in technical terms, a little more advanced than a truce. A truce only means two sides stop fighting. A ceasefire implies at least that they stop fighting and begin discussions to a permanent cessation. That's not happening. Neither Israel nor Hamas so far has indicated any interest in that. And so the neighbors know that this is not going to go away.
Bobby, do we have a sense of what Iran's role in some of these discussions have been, what their agreement has been since they were the financiers behind Hamas? Because we are seeing increased hostilities on the northern border with Hezbollah. Do we have a sense of whether they are in agreement with some sort of truce in the short term and in discussions for a longer term solution?
So Hamas is completely a creature of Iran. It is funded by, trained by, its weapon systems come from Iran, and the similar story with Hezbollah. Iran would have at least have had to sign off on the truce. I can't imagine Hamas making an agreement of this nature, even if it is temporary, without at least acknowledgement and approval from Tehran. Now, the Iranians have not been in person part of the negotiations, which have taken place in Qatar. Iran enjoys good relations with the Qatari authorities, so it might feel that it had indirect representation. But there was not. But as far as we've been told, some of these discussions have been secret. As far as we've been told, Iran has not been at the table in direct discussions. But like I say, they would not have. This truce probably would not have happened without Iran's tacit approval.
Yeah. Bobby, there's this question about just longer-term trajectory of what's going to happen, who's going to rebuild Gaza, who will govern it, who will be the leadership that really shepherds some sort of evolution to something else. And there seems to be, at least from what I read, and it is unclear, that there is a reluctance on the part of other Arab nations to really take part in that in any capacity. Do you understand how much wiggle room there is there, why this is?
Well, I can tell you why. It is because the Arab countries say that, look, we can't be responsible for cleaning up Israel's mess. That's the way they look at it. They say that Israel can't keep bombing the Palestinians and expecting that we'll turn up afterwards with a big checkbook and with humanitarian support to fix the rebuild these cities. And then a few years pass and Israel turns up and bombs these cities to the ground again. That's their official position. Is there wiggle room? There might be. I think the Arab neighbors will take on some of that responsibility if, and this is a very big if Israel this time makes firm commitments towards a permanent solution, a two-state solution where Palestinians, whether they're in Gaza or in the West Bank, are allowed to have a much greater degree of freedom than they enjoyed before all of this started, that there is at least that there will be progress guaranteed, whether by the United Nations, the United States, another group of nations, guaranteed progress towards a permanent two-state situation where the Arabs and Israelis can have their respective freedoms under supervision and guarantee, with assurances from both sides that there will not be a resumption either of terrorist attacks by Hamas or of military attacks by Israel. If that sort of a deal is on the table, I could see the Arab states saying, okay, we'll take this.
Bobby Ghosh, thank you so much for being with us and for giving us that clarity. Bobby Ghosh of Bloomberg Opinion. We really appreciate it. Coming up, we've got Mark Chandler of Bannockburn discussing the latest when we do see this ongoing weakness in the dollar, how long that can last, what we are seeing in markets. Quiescent, as Tom says, up about 0.1% in the S&P. 10-year yields up markedly, and we'll talk more about that. 3 hours to the start of the trading day on this post-Thanksgiving Friday. Welcome. This is Bloomberg Surveillance. Tom Keene, Jonathan Ferro, and Lisa Abramowicz. Tom and John both off together, maybe admiring John's tree. Gina Martin-Adams very much here, which we are really grateful for. So we can add that to our list of thanks. What we're seeing in the markets is a quiet day, although interesting more in the bond space. We could see that equity is just a little bit of a lift, but giving it back as people parse through some of the Goldilocks talk, plus the prospect of potentially some sort of slowdown. NASDAQ giving away after some of the incredible rally that we've seen. But in the bond space, I really think this is fascinating. And we'll get more into this in just a minute. But Gina, to me, the idea that Europe's market is actually dictating a little bit of the action of the U.S. and that the fear of issuance seems to be climbing back to the fore.
Yeah, and I think it's a global trend among developed markets who spent a lot of money to shelter their economies through the pandemic experience, and that money is continuing to be spent. Now it's a question of how do we fund it? How do we pay this back? Because as we all know, once you start spending and you initiate programs, pulling them back is almost impossible at the federal level. And I think we're experiencing this throughout developed markets. So it's just another stark reminder of the issues that we're having at home are also being replicated abroad.
I thought you were commenting on how people feel about the retail season. Once you start spending, it just keeps going and going. And you are seeing a bit of a euro pop, although marginal. 109.12. It is amazing to see how much euro strength versus the dollar there has been over the past couple of weeks. We were at 106 a couple of weeks ago in terms of the cross. But again, how much does this have to do with slightly better than expected data over in Europe versus this feeling that maybe the U.S. isn't going to raise rates further and we are going to get some sort of rate cutting cycle that starts next year? Under surveillance this morning, a 4-day truce is in effect between Hamas and Israel after weeks of delicate talks. Qatar, the U.S. and Egypt all are brokering the deal. Hamas is expected to release 50 of nearly 240 hostages it captured from Israel last month. Israel will release 150 jailed Palestinians and allow more aid into Gaza. This is the first major pause in fighting since the attack on Israel by Hamas on October 7th. The Israeli military vowing the war is not over and will continue once the truce ends in order to destroy Hamas. I have to say, Gina, I spent a lot of time thinking about just the details, the granular details about this agreement. What kind of trauma the hostages who are released are going to be coming back with, right, in terms of coming to a hospital and getting cared for. What's going to happen to people who have been displaced and are trying to figure out what do we do next now that we don't have to worry about being bombed? The amount of trauma in all of these parts is just mind-boggling.
Yeah, and also that the idea that this trauma is only potentially partially paused. I mean, this idea that it's a 4-day pause and yet it's coming back. There's no guarantee that there won't be more hostages taken after 4 days. There's no guarantee that this doesn't just re-engage. This whole conflagration just continuously gets worse. And I think that that's the sort of broader scope is, okay, we've got this temporary pause and wonderful, 50 people will potentially get relief, though traumatized as a result of their experience. We're doing nothing necessarily to extend this pause into something else. There's a very strong commitment on both sides that we will re-engage. And that's my concern is, okay, so we get a little bit, but no guarantee that this is the end, no even steps, it seems, toward an ultimate resolution of this conflict.
Something that will be developing, I'm sure, as it has been throughout the days and weeks ahead. We were just talking about the spending of developed markets. German Economy Minister Robert Habeck calling for radical reform to borrowing as Europe's largest economy looks to avoid a deeper slowdown. The German government has announced has a constitutional limit on net new borrowing. But that has been lifted for 4 consecutive years due to the pandemic. And Habeck, speaking to the Green Party, who previously wanted to have a balanced budget, said, quote, "We have voluntarily tied our hands behind our backs and are going into a boxing match. The others are wrapping horseshoes in their gloves. We don't even have our arms free." To me, this really highlighted this feeling of frustration in a place like Germany that has not been a massive fiscal spender, even when rates were actually amenable to their being so, and now are facing off competing with the U.S. with different, the IRA, with different subsidies in different nations, and saying, what are we going to do now? We got to keep spending.
Yeah, I don't completely understand the metaphor of the boxing match and who are they boxing against. So I need some clarity on what's happening here.
Spend some time with it.
But nonetheless, so I'll take a minute on that. But I do think it is symptomatic of the fact that every economy did their best to get through the pandemic experience, and now backpedaling out of some of those commitments is just very, very difficult to do at a time, especially when interest rates are going higher. This is the bond market's primary concern. We've moved from a concern of inflation, supply dynamics resulting in longer-term inflation pressures to what are we going to do with all of this debt? How are governments around the world going to ultimately be able to pay back what we spent during the pandemic? And there's no resolution on this, and I do think it'll continue to weigh on us for some time to come.
And our third story, Elon Musk taking it to X, calling it, quote, insane that a number of labor disputes in Sweden can directly slow Tesla's operations there. Dock workers, garbage collectors, electricians, and postal workers refusing to do anything related to Tesla. The move, protected in law, is in solidarity with a Swedish industrial workers union that has been on strike for the past month, shutting down repair shops. Talks to end the strike have reportedly ground to a halt in Sweden. About 2 in 3 working adults belong to a union. Mm-hmm. It just kind of highlights the thrust of labor and how much Elon Musk has tried to avoid any interaction whatsoever with that kind of organized movement.
Yeah, and I find this really interesting because if you think flashback a few months ago, we were all talking about the UAW strike, which really only impacted the American automakers to a large degree, the traditional GM and Fords of the world. And Tesla kind of skirted around the edges, all the electric vehicle workers not part of a union in the United States. Generally, Tesla did not experience that distress. But here it is coming at them from another area of the world. Labor is, in general, in a very different position globally than they have been in the last several decades, given just a lack of workers, a lack of available labor. They have a degree of power, and they are certainly using it to the best of their ability.
I have to say, one of the hottest topics at Thanksgiving was who's going to suffer the biggest job losses as a result of artificial intelligence.
Okay.
And we all decided we should become plumbers and we should become, just anything that is in the physical world, because that's what cannot be disrupted as much as some of these other white-collar jobs.
It requires services, hands-on service workers. And there's not a lot of displacement that can possibly happen.
Anyway, shifting gears a little bit to the market of currencies. Mark Chandler, Chief Market Strategist at Bannockburn, who doesn't have to weigh in on exactly which jobs are going to get disrupted by artificial intelligence. But we were just talking about Germany and the fact that they are kind of abandoning their net zero, their net neutral debt issuance yet again because they're trying to compete. How does this affect how you look at the developed market world at a time where inflation is a problem and spending is still necessary in terms of the politics?
I think you're right, Lisa, that the sell-off that we're seeing in U.S. Treasuries today, I think the 10-year yields of about 6 basis points, is really playing catch-up with what's happening in Europe. And I think you're right, too, that the focus is on Germany. A high court decision earlier this week said that many people, I think that Germany is some kind of fiscal example of fiscal austerity. But in fact, what they've done is they've put a lot of things off budget. And the High Court ruled that what it's trying to do off budget is unconstitutional. This has blown about a 35 billion euro hole in the German budget. And so that's why they're extending that break. And this is really the tragedy. Remember earlier this year, the Greens, who have the whose decision it was within the German government, were forced to really swallow their pride, swallow their values, and extend the nuclear plants for a bit longer, given the energy crisis in Germany. And now we've got the Free Democrat finance minister, Linder, suggesting that he's had a compromise. He was the one who really advocated reinstating the debt brake, and now he too has had to backtrack. And I think that this is a particularly European problem, and I suspect that U.S. yields might have stayed a bit lower if it wasn't for what's happening in Germany and Europe today and yesterday.
Can you talk to us a bit, Mark, about how this translates into currencies? It does seem that the entire global financial markets are in one big trade. The dollar rallies, S&P 500 sells off, yields are rising. And then the reverse has been happening since early October. How does this play out in currencies? And will we get to a point where we ultimately see some detachment in all of those markets emerge? What will create that point in time?
And I think you're right. I think there is like one big trade, if you will, going on. But I wouldn't begin it with the dollar or the stock market. I'd begin it with interest rates. And I think that, we saw the dollar strengthen from about the middle of July through early October, partly even into November. And it was partly on the idea that of this divergence. The U.S. looks so much better economically than Europe. The Eurozone luckily to stagnate or worse in Q4. The Japanese economy, as you know, contracted in Q3. China's economy struggling. So the dollar rallied. It's sort of like the driest towel on the rack, if you will. And I think that divergence is reversing itself now. We got convergence taking place with the U.S. economy poised to slow down dramatically here in Q4. And I think that has helped push interest rates lower. Remember, we were seeing the 2-year note in the U.S., and that's what I'd focus on for the currencies at the shorter end of the curve. The U.S. 2-year got above 520, and we're trading closer to 480, 485 or so now. And I think that this is just a reflection of the market anticipating the Fed cuts. And the Federal Reserve told us in September that they were still planning on cutting rates twice next year, even though inflation won't be at its target.
Can you give us a little bit of sense of what's happening with emerging market currencies as well? Because I do sense that there is some divergence there where there's one big block trading around the dollar, and with respect to developed markets, emerging markets seem to have some evident divergences. What's going on in emerging market currencies right now?
Yeah. Thanks. It's hard to talk about the emerging markets as a homogenous block, as you know. I think that what's been attractive to a lot of people this year has been the Latin American currencies, typically high interest rates, commodity-backed. And I think that this has left, when you look at the other zones, the Central Europe sort of dragged down by the euro and the weakness of the eurozone and European economies. Asia currencies, you've had a lot of challenges with China, but recently both South Korea and Taiwan has seen an increase in their exports, especially of technology. And this is seen to be a sign of maybe a better recovery. I think the Mexico story is really the outstanding one. Mexico, despite an appreciating currency this year and last year, Mexico's exports remain strong. Carry is large. That is, they have an overnight interest rate of 11.25%. So you're still able to get a double the return that you can on the U.S. And they have strong central bank independence and a strong Supreme Court that sort of has given us guardrails to some of the more populist policies coming from the government. So I think you're right. When the Federal Reserve begins easing, and that might not be until the middle of next year or so, I think that helps put it like a floor underneath some of the emerging markets.
Mark Chandler of Bannockburn, thank you so much for being with us. We really appreciate it, and happy Thanksgiving. This has been one of the biggest questions, really, is sort of what's going to happen in China, what's going to happen in Asia to drive growth at a time where that had been the engine for so long. There was a story overnight talking about how China seems to be gearing up to support its property market much more substantially. Yep. I don't know how much people are going to buy this, but it seems like there's something a little bit more underneath this.
Yeah, and expectations are so low. I think that China is a potential big bright spot emerging in 2024 that nobody's talking about. So take whatever I say with a grain of salt. But nonetheless, I do think that much of market sentiment really over the last year has lined up around the idea that China's a giant disappointment. There will be no geopolitical resolve between the U.S. and China. China's a standalone nation now. And we got to the point of, I think, where this trade was extreme. And that opens up an opportunity for China, even if they don't do a lot, there is an opportunity for upside. But if they do come into the market and start supporting the property markets, start really trying to reinflate and stimulate growth, and also, importantly, to try to repair some of their geopolitical relationships, in particular with the U.S., which we did see signs of that emerge last week, this could be a really big upside positive story that emerges in 2024, and no one's talking about it, but nobody's expecting it.
People were saying it's uninvestable.
Yep.
People were saying
absolutely
it's not something that you can buy. I'm curious whether you think that companies bought the message that Xi Jinping was selling?
I don't know. It's too early to say yet. It's just too early to say. I think they're really reticent to do so.
All right. Well, we'll sort of track that. I really do wonder about that. Coming up, Shannon Siri Grein of Wells Fargo talking about what we are going to see in this retail season.
What we're seeing is half of consumers are actually saying they are going to spend more this year. I think what you are going to see is that consumers are much more focused on value than they've ever been before, and we're seeing that in shopping behavior this year.
That was Mark Rosen, CEO of JCPenney, taking a look at what to expect going forward for the holiday season. I was doing some research, and it looks like about a third of people surveyed, Gina, are going to use artificial intelligence and other generative AI to do their shopping for them.
You're kidding.
No, with like ChatGPT and things of that nature.
Wow.
They wanted to use artificial intelligence to surface good deals, brand recommendations, and gift alternatives. Basically, hey ChatGPT, what should I get?
Yeah.
My 13-year-old
I guess
child.
it makes sense. Do this for me. Make me more efficient. Help me out. It's interesting because I would have never thought to do this, but I suppose it's a kind of a natural evolution in the way that we shop online. We are getting sort of ChatGPT is right at the top of any search that you do now. So it kind of makes sense that you might take advantage of it. But wow.
Yeah, and I also
it's really hitting us quickly.
Yeah, well, and I think about probably the generational divide and people who are used to taking more shortcuts when it comes to thinking through things, which may add to productivity. Joining us to talk about not that, but the retail season ahead of us, Shannon Siri Grein, economist at Wells Fargo. Thank you for being with us, Shannon. I want to start with your expectation for a 5% gain in sales for this holiday period, which is pretty good. Is it good enough?
Yeah, right. So the way we've been characterizing this holiday season is that it's going to be decent. So it's not going to be a blowout year like some of the years we've coming out of the pandemic, the last few or so, but above average. So the average annual gain over the past decade or so has been closer to 4%. So we think that momentum we've seen in the first half of the year is really going to carry us through here towards the end. But there is some worry growing among consumers amid still elevated prices, rising interest rates, things of that nature starting to weigh on consumption a bit. So a decent holiday season, 5%, again above that long-run average, but a step down from the rates we've seen over the past few years coming out of the pandemic.
Is it a good signal or a bad signal if people really come out to buy deals, if they're going to be looking for the biggest discount in order to buy?
Yeah, I mean, I definitely think we're going to see a consumer that's really deal hungry. So we did see a lot of retailers trying to pull forward holiday sales. So we saw sales activity starting in October of big box retailers online and in store. Even though today's Black Friday, obviously some of those sales have happened in the past few weeks. We're starting to pull forward where it's really Black Month rather than not just one day, right? The whole month has really become characterized by sales activity for the holidays. So I do think we're going to see consumers pushing for those deals, even as inflation slowing. We're still seeing that prices are well ahead of where they were ahead of the pandemic. So I think that's just adding to a consumer picture where they're dealing with higher prices, they're dealing with higher interest rates, they're also facing less liquidity, and a lot of these factors come together where a consumer is looking for more deals this holiday season in order to, purchase all those gifts. So I don't know if it's necessarily a good or a bad thing at this point, but I do think it's indicative of this consumer progression that we've seen where households just have less liquidity at their fingertips to rely on in order to spend this year.
Shannon, do you do any work to sort of disentangle what that 5% means in terms of net sales, volume sales, in other words, versus the total sales picture? This is something that's popped up in equity markets repeatedly over the last 6 weeks, is really how much are your net sales, you consumer company? Because the investor base really wants to see the volume come through, understanding that inflation is decelerating.
Right. So when we think about that 5% figure that we forecast, that is nominal. So when we adjust for inflation, that will be lower. But in terms of volume for sales, we still expect most of the sales activity to happen towards the end of the holiday spending period. So in December, volume is going to be higher than last year, but not nearly as much as that 5% figure indicates, because that is not adjusted for inflation, as you mentioned there, Gina. So there is some effects there in terms of the volume measures as well, in terms of how retailers can assess this year versus years past.
And can you talk about sort of what drives your forecast? Because I think it's really interesting to see a 5% growth number in an environment where suddenly the consumer sort of outlook has turned quite grim over the last couple of months, with consumer sentiment turning over. Are you generally seeing that consumer sentiment is going to lead to a slower sales pace, or do you sort of dismiss that as a short-term impact?
Sure. So the sentiment and confidence measures, I do think, can be somewhat overlooked in the near term. The fact that sentiment and consumer confidence more generally have been very low, and consumers have continued to spend at a robust clip over the past 6 to 12 months is indicative to me that they don't move one for one. Sentiment is very much more driven by inflation. So we actually might see a bounce in the next few months given lower gas prices. But when I think about the spending environment specifically, I mean, consumers are becoming a bit more vulnerable. So we do have momentum from the beginning of this year, helping feed a decent holiday sales season. But as liquidity dries up, as rates move higher, borrowing costs become more expensive, I think that's going to impact the consumer. And then when we think about the nuances with that 5% figure, I mean, there are a bunch of different retailers and categories to discuss, right? So hobby stores, electronics, things that saw a significant run up throughout the pandemic are likely due for some payback this year. And then also those interest rate sensitive categories are probably not going to experience as much of a gain as well. So I think you do have some nuance under the hood of that above average gain that we're forecasting.
The picture that you're painting sounds a lot rosier than some of the discussions that we heard from the likes of Walmart's CEO and others, where they were talking about possible deflation and a market deceleration in the past 3 months from where they had been thinking earlier. So do you have this sense that maybe things are moving quickly and we might get the early signs of a more significant slowdown? Or do you think that this was idiosyncratic to specific companies that deal with specific clients?
So I think it's a bit of both, where you are seeing a slowdown from the past few years. And I know this is a simple point, but I think it sometimes gets overlooked in the sense that we are coming off of some extremely high base effects coming out of the pandemic in terms of retail and holiday sales specifically. So the slowdown doesn't surprise me, and our overall forecast for next year is still rather weak. I think risk of recession is quite elevated. So when we go into next year beyond the holiday season, I am growing more and more concerned about the consumer generally. But I do think that we can get through this holiday season with somewhat of a decent gain. I don't mean to come across overly optimistic. I think consumers are starting to struggle a bit more, but I think it will come out with just a decent holiday sales gain, just given that momentum we've seen. So I don't want to dismiss the pessimism or weakness that we're hearing in some of those equity reports, but I do think that it really depends on how we transition to next year in terms of the consumer picture more generally.
I'm old enough to remember when people would line up outside of stores and they would try to get the deals. And I remember when people would flood in and the shops were completely crowded. And over the past couple of years, shops haven't been that crowded on Black Friday. And there has been this feeling that people are using them as dressing rooms, frankly, to go order things online, or they will just stay at home and order online. How much has it, to Gina's point earlier, gotten spread out, where you're not necessarily going to see all of the consumer spending on Black Friday in the same kind of way, and you have to look more toward Cyber Monday and the Amazon sales as much as anything else?
I definitely think it's getting spread out. So I'm with you, where I remember people lining up outside of stores today, the Black Friday that traditionally was. And I think those sales have been pulled forward throughout the month and then even into October. So retailers are smart, where the earlier that households spend on holiday sales, the more likely they're going to spend over the whole season. The October retail sales report did come in a bit weak, so I'm not sure how much sales was actually pulled forward into October, but obviously spending has been happening throughout the month of November. And as we get that data, it will be indicative of how it's going to happen over the course of the next month as well. A lot of the survey evidence does suggest that consumers are increasingly looking to spend more in December as well. I think that's really that deal-driven mindset is coming in. So I think, it's part of this game where retailers are trying to spread it out more so, and consumers are reacting to that when they see a deal, particularly as they become more vulnerable in terms of less liquidity out there. But I definitely think it's more of a spread out season than it has been historically.
Shannon Siri-Grine of Wells Fargo, thank you so much, and have a wonderful weekend. Gina, are you going to be shopping this weekend?
No.
Okay. I actually tried to get the boys to go shopping because they need clothes, and my younger son just said to me, absolutely not. It is so crowded. I don't want to be with crowds. Oh boy, what have I created?
I haven't gone out shopping in person over the Thanksgiving holiday weekend in years. It's just not something I generally do. We do a lot of family activities. We do a lot of searching online. I get lists together and that kind of thing, but there's not a lot of shopping that happens for me over holiday weekend.
What was the hottest topic last night? night at Thanksgiving?
Oh, good question. We talked a lot about generally what's happening with our kids in schools. So this is not, I can't
Hot
say
topics.
that we were talking about the financial markets. It just didn't come up.
You didn't talk about
even the
sort of
political situation didn't come up. It was really more, and again, this is a neighborhood gathering, so it was more about kids in school and what are kids dealing with? How are we going to deal with our kids who are in middle school going into high school? Where are things headed? It was all about our children. We're just kind of kid obsessed.
And then the family one comes, and then things might change.
Yeah, family Thanksgiving might be a bit different.
Yeah, we talked a lot about generative AI. Coming up next, Macy's CEO Jeff Jeanette talking about the shopping outlook, or Caroline Hyde is going to be with him on the floor, looking at the crowds, or maybe not. Let's check it out. This is Bloomberg.
Higher for longer sort of narrative is still very much in play.
Inflation has been high, and at some point that should weigh on activity. We probably do get some type of broader downturn in the economy.
I don't think there's a recession coming next year. It's just a gradual slowdown.
Highest conviction trade is no eases. Fed on hold till at least after the election.
It needs to be a pretty catastrophic crisis, I think, for them to be forced into really, really loosening policy.
This is Bloomberg Surveillance with Tom Keene, Jonathan Ferro, and Lisa Abramowicz.
Here comes the retail therapy. Good morning. Welcome back. This is Bloomberg Surveillance on radio and television. Tom Keene, Jonathan Ferro, and Lisa Abramowicz. Tom and John both enjoying their post-Thanksgiving day. With me, I am so pleased to say Gina Martin-Adams is joining to discuss and go through what we have learned this year, and also to check out the holiday sales, because that is the tradition. I'm just curious. We've not talked about the incredible rally in stocks and the amount of money that's just been flowing in. How much is retail therapy just buying equities in the U.S.?
I think it's very little retail therapy, frankly. I think most of it is just a reflection of where we were. Remember, we had a greater than 10% correction from July to October. We got deeply oversold. Sentiment was extremely low. We've got a nice little seasonal tailwind that tends to emerge in November and December. So I would attribute it more to short-term dynamics than any sort of long-term confident recovery rally that is the start of a major shift, at least yet. Who knows what could emerge with respect to the fourth quarter and trends, but I think it's more short-term than I would like to see.
Bank of America Global came out with this piece of research citing EPFR data showing that global stock funds saw $40 billion of inflows in the past 2 weeks. That was the most going back to February of 2022, so almost 2 years. And that even then, you take a look at what the inflows this year have been. It has been $1.2 trillion into cash funds and only $143 billion in equities. Cash is still such a big draw relative to stocks.
Yeah, and I mean, can you blame investors, though, when you've got the yield on the equity market, depending upon how you slice and dice it, is somewhere between 5 and 6%. If you're going to get 5 to 5.5% on your money market, why stocks? Why take the risk in stocks? So there's a rationality behind this. When you're getting paid to own cash, investors are generally going where they're going to get paid. And there's very little confidence that the equity market can produce some sort of much greater, more robust earnings recovery to improve the valuations in the equity market.
The lack of confidence is apparent today, where you're seeing basically not a lot of action. It's also probably because most people are home and tryptophan-induced slumbers. There has been a slight lift to the S&P, although the NASDAQ is slightly negative. S&P futures up about 0.1%. The euro gaining just a touch against the dollar after some better than expected European data. 109.14. 10-year yields coming off some of the earlier highs. But to me, this is interesting, nudging upward. 4.46%, up about 6 basis points after it was clear that Germany is planning to keep spending, and this sort of fiscal impulse. We were talking about this last hour, but to me, this actually is one of the biggest stories and biggest question marks for this market.
Yeah, and I would totally agree. What happens in the bond market is incredibly important to what ultimately happens in all asset classes, all risky asset classes as well. And we saw this emerge over the course of the last 6 months in particular, but really over the last 2 years. The bond market is the leader. and all the rest of us are just kind of trailing along behind. So what happens with fiscal spending, what happens with government debt is incredibly important to determining the outlook for all asset classes right now.
All right. Well, what we're looking at today, coming up in just moments, we're going to be hearing from Macy's CEO Jeff Gennette alongside our colleague, Bloomberg Television's Caroline Hyde. We will get to that in just a moment. 9:45 a.m. S&P Global U.S. PMI data coming out. Particularly interested in the services sector. Do we see a fall off there? And markets do close early. Stock market closes at 1 p.m. Bond market closes at 2 p.m. Let's get to it. It is an important conversation on a day devoted to celebrating retail sales. Let's head over to Macy's in New York City's Herald Square, where Bloomberg's Caroline Hyde is joined by the company's CEO, Jeff Gennette. Caroline.
Lisa and Gina, it's a joy to be with you, with Jeff Gennette. Of course, on a day where people queue, they run in, the celebration is upon us, your Super Bowl. What are they buying today for Black Friday?
So they're buying everything on their gift list, and they're buying, that's really generally in luxury. So fine jewelry, they're buying cashmere, they're buying outerwear for the entire family. Hostess gifts in our home store, but they're also home prep. We've got great deals, as we always do for Black Friday, going all the way through the holiday season. So we are ready. We've got all of our key items, loaded to bear. Here we are in Herald Square. It was a good opening. We had a great day online yesterday during Thanksgiving.
I mean, you said that on your earnings, which were, about a week ago.
Yes.
That this gets earlier and earlier.
It does.
Black Friday, the competition. How important are the next few days and the run-up to the holidays?
Oh, it's still very important. So, when you think about kind of Black Friday deals really started right after Halloween is when they started. But this is still a pilgrimage. You've got, America is traveling, and they are in homes, and they're coming into stores just like this one today. They're online. They've been online all the way through. So it's very, very important. So when we look at kind of Black Friday through Cyber Week, then we go into a lull. It's like 10 days where people kind of reset, and then those last 10 days become increasingly important. So it's one of the 3 stages right now that we are of the kind of the Christmas shopping. It's the one we're in right now, the first.
What, of course, your earnings showed so clearly is that it's about inventory management in many ways at the moment, and you've been managing to ace that. How are you ensuring you got the right thing at the right time for a consumer that basically we're all trying to understand right now?
So obviously the consumer's under pressure, but they still love gifts. And so we want to make sure that we've got all the right gifts and we've got all the right stock content in them. So I just walked this entire store to really understand where we are in all of the content across all of our categories, and we're in great shape. And that's really in tribute to the amount of work we've been putting in inventory control.
And when it comes to online versus in store, in retail, this is how you've been shifting the company. In particular, people aren't perhaps having the footfall in malls, they're coming to one-off stores, they're going to smaller store experiences, but e-commerce has just been the focus. How are you managing to be at the right time in the right place for an omni-channel purchaser?
So really, the strength of Macy's and Bloomingdale's and Bluemercury is that we're omni-channel and we're omni-category. So what you have is you have customers that are shopping online, they want to come into a store and try it on, and they maybe are transacting on the couch later that night. So the opportunity to make it as convenient for the customer as possible, however and whenever they want to shop. So that's our beauty, and doing that with a national footprint, with a great website, is what we depend on.
And of course, why you've got such a great bird's eye perspective, because you do have Bloomingdale's for the higher end, more luxury purchaser, and then more income breadth when it comes to Macy's. What are we seeing in terms of the consumer? Are they going to be spending more? Are they going to be pulling back?
So you do have customers that are under pressure. And so when you think about the inflation is still high, it's abating from the change of the inflation rate from last year, but it's still higher than it was last year. And customers have got a limited budget. Some of it is they're spending it in experiences and then in our discretionary categories. So we want to make sure that we've got the right price points across that entire spectrum. But you still give gifts. And this is where Macy's and Bloomingdale's and Bluemercury shine. So when you have this gift, somebody on your gift list, we're going to have the right content for you at the right price point. And we spend from when Black Friday ends to where we are right now, we've been spending a year getting ready for that. And we do trial runs on Valentine's Day, Mother's Day, Father's Day to make sure we've got the right gifts. We're ready.
You're ready. People are worried, analysts might be worried, that you're kind of managing decline at the moment. What would you say to a comment like that?
Look, I think that if we weren't a department store today, we would invent one. So the idea about having multi-categories, being able to do that in multi-channels, we now have been able to get new categories in as a result of Marketplace, which is now online at both Bloomingdale's and in Macy's. So I bet on department stores. And obviously I made my career doing this. And it is it's still very, very relevant. We're obviously looking at where traffic is moving from on-mall to off-mall. We're obviously testing that in both Bloomingdale's with the Bloomies format and with Macy's with Macy's. And so we're going to be ready for where the customer is evolving. And we've got very strong assets to be able to do that, both on mall and obviously online.
Evolving into a world where we're all using chatbots and artificial intelligence are front and center, and these are sort of areas of investment?
Yes, absolutely. Because when you think about AI and machine learning, you think about when we have 40 million customers at Macy's, 4 million at Bloomingdale's, we know them very well. So to have all that data and be able to start to personalize content and values for those customers is where this is all going. How do you make your brand more relevant? And that is at a customer level. It's no longer broad-based promotion. It's the opportunity to be able to, I know Caroline, and based on what you buy, what you might be interested in, and to be able to serve that up in the way you want it served up is really the secret of success for an omnichannel retailer going forward.
You, of course, just mentioned throughout your career this is what you've been doing.
Yes.
For those who don't realize, you've worked at the Macy's brand for more than 40 years.
Yes.
And this is your last Black Friday.
Yes.
And of course, CEO since 2017. You have been thought of as a turnaround focus, the polarist, the way in which you have thought about personalization, e-commerce. You weathered, of course, the COVID in and of itself. Do you feel that you've got this Macy's where you want it to be as you look towards this being your last Black Friday?
Yeah, look, when I reflect back on my career, and certainly in my time in CEO, I didn't accomplish everything that was on my list. But look, the focus on relevant content, on amazing values, and on customer experience is clearly the path forward. And I couldn't be more excited about my successor, who is more than ready to be able to do this. He knocked the cover off the ball with respect to Bloomingdale's and what he was able to do there, how he was able to kind of help turn around the strategy of Bluemercury. He's now going to do that for Macy's Inc. So he's got a good game plan, and he's going to make it better.
Jeff Gennette, we thank you so much for spending time with us on what is your last Black Friday, but still got a few more days in there. And of course, the job, he's here until February as the CEO and CEO-elect Tony Spring. But with that, we send it back to you in the studio.
Thank you so much. Bloomberg's Caroline Hyde and Macy's CEO Jeff Gennette on his last Black Friday on the floor talking about the importance of gifts. And Gina, that was something that he kept emphasizing. People still buy gifts, even if they are focusing more on experiences for themselves.
Right, exactly. Even if they're pulling back elsewhere, they're going to do what they can to buy those gifts and make the holidays a special time for their loved ones. And I think that that's a good point. The other thing that he brought up that I thought was really interesting is that shoppers are still going direct to luxury. They're still buying high end. They're still looking at those high end products as opposed to looking at sort of the extreme discounted products, which is a very big divergence, I think, relative to sort of the commentary that we've been having about how the consumer is focused on value, how the consumer is focused on, finding the best deal. Maybe they're finding the best deal, but they're also looking at those luxury items as a component of their gift strategy.
And there also are different shoppers, right? So that's why I was wondering whether the Walmart story was very different from the Macy's story or for some of the other retailers that maybe are getting people who are looking for discounts. But to your point, in the highest priced things, it's not like they're looking for discounts for milk and bread.
Right. And it does reflect the big divergence that we have in experience at the various income levels. Americans at the higher income levels, even though they're also spending more on food and gas as a share of their overall budget, those are small movers compared to consumers at the lower and middle income levels, where higher food prices, higher cost of the Thanksgiving dinner, generally higher cost of gas at the pump, all of these things generally weigh on their sentiment significantly more.
Coming up, a gut check on whether this Thanksgiving dinner really was more expensive, at least than last year. We'll be talking about that. If you are just joining the program, we're looking at equities basically range bound. S&P futures up about 0.1%, a quiet morning ahead of the opening bell. Coming up at 8 a.m., we do have Michael Purvis of Talbot and Advisors, and we also have later in the show Justin Wolfers, the economist, who talks about how actually the price of a Thanksgiving dinner has gone down materially, but the difference is that that's year over year.
Exactly.
And this is sort of what people are focused on, right? And this sort of goes to the divide of why people feel so much worse than the overall economic data might suggest.
Big difference between what the financial markets think is important in inflation and what the everyday consumer thinks of inflation. And I think that we're seeing that play out real time in consumer inflation expectations. We can dig into that a little bit more, but generally Wall Street cares that inflation is rising at a slower and slower pace. This disinflationary kind of outlook is very important to asset prices. But is it enough to really change the consumer psychology? The details would tell you no. The consumer's still very worried about inflation. They're still very worried about price increases. They're still thinking about price as a component of their overall budget is much higher than it was several years ago. And so year over year, Does that really matter to the consumer? I would venture to say no.
And I wonder how much this is also a housing story,
Yep.
more than many people would realize.
Absolutely.
Just because a lot of people are either locked into their homes or locked out of buying or forced into renting or forced into a smaller space. How much is that one of the biggest things underpinning some of the dissatisfaction?
Yeah.
We will discuss coming up. We also have Terry Haynes that's coming up next, Pangea Policy, to talk through what we can expect in the tear into year end for the political season, for the geopolitics in markets. Quiet morning, but really I focused on the bond yield space, given what we saw over in Europe. Yields just inching higher, not a lot of drama, but still a bigger move than in the past couple of weeks.
This hostage exchange will provide about 4 days for them to ingest is what must be a massive amount of information, from prisoner interrogations to laptops, to shape future attacks in 4 or 5 days.
That was Norman Rule of CSIS speaking to us in the last couple of days as we prepared for the ceasefire that has taken place. It is a temporary ceasefire, a pause. The language is disputed, as well as we do get some sort of brief reprieve as the hostages who have been held by Hamas are returned to Israel. Some prisoners are released back to the Palestinian people, and there is this question of how long it can last. Joining us now, Terry Haynes, founder of Pangea Policy, and I want to start with what's happening, what the U.S. Negotiators are doing during this pause, during this cessation in fighting.
Well, they're grabbing as much information as they can, as your guest just said there a minute ago. They're trying to figure out as much as they can. All the rest. The other thing that's happening, frankly, is that the Israelis are resting and replenishing a little bit, because what needs to be understood, I think, is that the ultimate war aim of Israel hasn't changed, which is the destruction of Hamas. And I think that if people think there's a serious deflection or difference in how Israel is going to try to prosecute this war going forward after the ceasefire is over, I think they're mistaken.
Do you think that there is this feeling that the pressure is getting too great on President Biden for him to take a role in anything other than trying to argue for some sort of prolonged cessation in fighting?
Well, I think the president is focusing on what he can focus on that's the likeliest to yield a result. That sounds a little prolix, but let me hone in on it. Biden can have influence on, and we've seen the influence on having a ceasefire. Biden's ability to influence Israel's war aims or how they prosecute them, I think, is very limited, and I think it's going to remain limited. This is a two-edged sword for the president. They certainly want to celebrate the idea that they've gotten some of the hostages out, and to the extent they can deflect Israel's war aims, that allows people within the administration to try to prosecute their vision of what Middle East peace should look like. But I think we shouldn't overestimate the degree of influence the president has on the prime minister or the Israeli government. We should always keep in mind, from the Israelis' perspective, how deep and profound a shock the October 7th incursion was and is, and how that's going to influence what the Israeli government and the Israeli military do going forward.
Terry, presuming the truce does not lead to a ceasefire, which seems to be the general consensus view that we will not ultimately get a ceasefire and this war will continue, how do you see that impacting the U.S. presidential election come 2024?
Well, it tends to depress enthusiasm among Democratic regulars for Biden. There's a big split, and that enthusiasm is already not great, as everybody knows. But the degree to which the international situation continues to look parlous, the degree to which, from a sort of more market terms, geopolitical risk continues to look high, and I've said that I think it's the highest geopolitical risk in 50 years, that augurs against the president. That makes people a little bit less enthusiastic, more willing to take another look. frankly, gives opposition on the Republican side, no matter who that is, the opportunity to say, look, we need something that's more coherent and more consistent and has particular goals in mind. That's how we protect America. That's how we project our power, all that sort of thing. So it's a very difficult time for Biden, I think.
And if you dig a little deeper into the Republican candidates and how they are distinguishing themselves, is this issue coming up as a distinguishing factor, or are they all sort of in the same general camp? And then how could it play out with respect to the Republican candidates?
Well, my view of this of the race is that you're really down to three candidates now anyway. You're down to former President Trump, and you're down to Governor DeSantis and Ambassador Haley. They all prosecute the line I just gave you before with a fair amount of consistency. I mean, they all have their ways of their own mannerisms and how they talk about that, but the line is fairly consistent. The only person in the Republican field who really wanted to take a different sort of line is Ramaswamy, who's never really caught fire and is kind of flatlining right now. So what you've got in the Republican side is kind of a strong foreign policy that is very internationalist and very interventionist, number one, and number two, very critical of Biden, of course. So they will all in their different ways. Trump is a former president. Haley is UN ambassador. Governor DeSantis tries to make up for his relative lack of foreign policy experience with talking about his service and his military service, and all those things inform the way they come at it. But frankly, it's pretty consistent across the board, and they're trying to draw the strongest contrast with Biden as possible. And in the Middle East, for example, they would point directly to the Iranian policy of the past several years, which they'd all characterize as failed.
Terry, it strikes me that people are exhausted with even the idea of this presidential campaign because they're going to be dealing with two candidates that polls generally show people do not want to run on either side, and there is this feeling of something new, and nobody wants to talk about it. And there was a survey that I was looking at that showed that over 90% of respondents, and it was published in USA Today, said they don't want to talk about politics. They don't want to talk about Joe Biden. They don't want to talk about Donald Trump. They don't want to talk about the 2024 presidential election at Thanksgiving dinner at all during the holiday season. Does that tell you something about voter enthusiasm, about turnout, about what could potentially happen between now and a year from now?
Oh, yeah. Fundamentally, I think what it tells you is the kind of the where the electorate is basically, number one, and number two, how unusual are people who will talk about nothing but politics incessantly. What I describe as purists on both sides have a disproportionate ability to impact, to influence how primary candidates are vetted and are chosen. But there is a great yawning middle that has, in my estimation, that has been looking for solutions, looking for the country moving forward, and is not getting that. It really very much feels it's not getting it. And frankly, they're exhausted between the politics and the pandemic of the last several years, and would like to get back to any semblance of normality. So, if there are candidates, whether on both parties or a third parties in the middle, and there's a great hungering for that too, I think, that can tap into that, the desire to kind of, get back to normality and stop the screeching. There's going to be a big audience for that, I think, and a much bigger audience than people anticipate.
Terry Haynes of Pangea Policy, thank you so much. Gina, I was struck by some of the other aspects of this poll. About 30% of Gen Z participants said they'd be celebrating with friends to avoid family drama.
Okay.
Just throwing that out there. Theoretically, for some people, it might be of note. Gen Z, topics of conversation by the category of generation. Generation Z, weddings, general gossip, and basketball. Millennials, travel plans and family planning. And Gen X, pets and football.
I wonder why basketball is overtaking football for Gen Z versus Gen X. Number one concern, clearly,
of course,
has to be about the
clear
sports.
one.
But that's kind of fascinating, isn't it?
Well, yeah, and the
politics generally way low
Nobody
on
wants
the
to deal with
priority
it.
list.
And honestly,
Yeah.
part of the reason why it's just so polarizing, and like Terry was saying, they're the people who can only talk about politics, then they're the people who don't want to hear it,
right?
Because it has gotten so polarized and tribal in its discussion points that it just kind of feels exhausting and like there isn't a meeting of the minds.
And inevitably leads to tension and really depletes the entire purpose of the holiday in general, which is to try to enjoy yourselves, enjoy your family, enjoy your friends.
Isn't that part of it? Is the tension? You know, what does Uncle Joe say this year?
Yeah, I guess we don't care anymore. We just want to have a good time.
We just want to talk about our pets. Coming up next hour, Anna Rathbard of CBIZ Investment Advisory Services joining us here on Bloomberg. To the open of a shortened trading day on Wall Street. Good morning. Welcome back. This is Bloomberg Surveillance. Gina Martin Adams here alongside me on a quiet day, but some interesting things under the hood after a tremendous rally in equities, as well as in bonds that seems to be put on pause. I wanted to take a look. Yes, you are seeing a little bit of a lift to S&P futures, just basically stasis across the board. But in the bond space, and this is really what I wanted to get from you, what do you think has driven this sort of shift upwards? Is it just thin trading, this inflection up in yields that have driven to the highest levels in 6 trading days?
Oh, I think it's inflation expectations. I think that University of Michigan inflation expectations number that came out earlier this week really sparked a bit of panic with respect to inflation becoming more of an embedded expectation in the consumer psychology. We'd seen so much improvement in the 1 year ahead inflation expectations on account of the Fed attempts to tighten policy that, people might have gotten a little bit complacent with that. But there's no need for complacency, as was clear. When consumers are saying your 5 to 10 year ahead inflation expectations are at multi-year highs, there's a real risk that the consumer inflation psychology is more permanently shifting, and I think the bond market is sussing that out to some degree.
Just to just sort of reiterate what some of those numbers were that came out earlier this week, the 1 year ahead inflation expectation actually increased from 4.4% to 4.5%, which I thought was highly unusual given that gasoline prices, which usually track pretty closely, have come down so much. And the 5 to 10 year inflation forward expectations, 3.2%, in line with what it had been the previous read, but above where the expectations were. It points to maybe this is the cumulative effect, or maybe there are other costs that are driving people's understanding of things, like housing, that outweigh maybe some of the others, like gasoline, that typically were the drivers.
Yeah, and we're so obsessed with sort of those short-term movements, we kind of think about we forget to include the aspect of the longer-term psychological shift, which absolutely does include housing. If house prices simply fail to correct in this environment where interest rates are higher and really preventing supply from coming on the markets, what does that mean for the consumer, the vast majority of the consumer base that is thinking about buying a house? Their perceptions of the cost, the embedded cost of living, are incredibly high. And I don't think we're getting any reprieve on that. Also, we've talked a lot about the Israeli war with Hamas today, and I do think that in wartime, consumers think of war as an inflationary dynamic. They think of spending. We're talking a lot about fiscal expenditures right now. The consumer psychology around that is, ooh, this is inflationary. I've got to be on guard for inflation. So even though gas prices are falling, and that's normally our main driver, it's not the only driver, and we're starting to see some shift.
And actually, in the Fed meeting minutes, they hinted at the wartime psychology and how that could be inflationary. Under surveillance this morning, speaking of this, a 4-day truce is in effect between Hamas and Israel after weeks of delicate talks. Qatar, the U.S., and Egypt all brokering the deal. Hamas is expected to release 50 of the nearly 240 hostages it captured from Israel last month. Israel will release 150 jailed Palestinians and allow more aid into Gaza. This is the first major pause in fighting since the attack on Israel by Hamas on October 7th. The Israeli military vowing that the war is not over yet. It will continue once the truce ends in order to destroy Hamas. Our second story is Barclays cutting as many as 2,000 jobs. This, at least, is according to a report in an effort to reduce costs by $1.3 billion over over the coming years. According to Reuters, top managers are reviewing the plan, which would shed about 2% of the bank's headcount. Barclays reported disappointing third-quarter earnings last month and lowered guidance again after already cutting its outlook in July. It raises a question, Gina, about how much cost-cutting there is within the financial sector. We've heard about this at Citigroup. We just saw another round of that. Is this the beginning of more to come?
I think so. Within financials, it's very interesting because we've seen this in bits and pieces really for the better part of 2 years. Back in the latter part of 2022, we saw mostly tech and communications companies cutting jobs, and that overwhelmed the story. But financials were cutting there too. So I think that this is an enduring trend where financials are really right-sizing and rationalizing their spending at large in an environment where the yield curve is inverted. They're not getting a lot of revenue opportunity through loan growth. They're having to really consider what their spending outlook looks like. But I feel like this is just a continuation, almost a death by 1,000 cuts in financials, as opposed to a renewed spike of any descriptions, particularly considering how small each of these cut programs announcements are, Citi's being a very small share of their overall bank, as well as Barclays now suggesting about 2% overall, and it won't come all in one chunk either. And I think that that's the bigger story here is financials is just kind of this overall weight. It's not adding any great job growth. It's also taking away job growth, but only in little bits and pieces.
Which is one of the reasons why maybe people haven't been that enthusiastic about it.
Yeah.
Black Friday shopping underway, but in a shifting form. Macy's CEO Jeffrey Gannett telling investors recently and reiterating to Bloomberg moments ago that, quote, the competitive landscape has really shifted to Black Friday deals prior to Black Friday. Despite a consumer wary of higher prices and borrowing costs, the National Retail Federation expects holiday sales will increase 3 to 4% from last year. That's in line with pre-pandemic shopping, but at a slower pace than at least 2 years ago, which makes sense because how much stuff can people buy? I mean, really, at a certain point, again, this sort of goods versus services dynamic that we've been talking about for quite a while.
Yeah, and their goods spending has been so depressed. This is where I feel like we have no expectations that they're going to do a whole lot anyway. So any sort of improvement in goods spending, even if it's very modest, would largely, I think, beat expectations. The real risk, in my opinion, is not necessarily that consumers don't spend a ton for Black Friday. It's that consumers slow down their pace of travel. They slow down their pace of going to restaurants. They really pick away at some of the services spending, which has been extraordinarily resilient and somewhat stronger than goods spending over time.
So taking a look at the retailer, this is going to be very much front and focus for all of us and for Anna Rathbun, Chief Investment Officer at CBIZ Investment Advisory Solutions, joining us. Anna, thank you so much for being with us. I want to start there in terms of your expectations and how much we will be able to tell about consumer appetite from this holiday shopping season.
Good morning. Over the years, I have learned not to bet against the American consumer because American consumers like to spend. And we do have a tradition of spending. And so the holiday sales, I think that we're going to see some strength, maybe not the levels that we've seen post-pandemic, but certainly to rates that we were used to perhaps before the pandemic back in 2019, right? But the consumers aren't the same as 2019. We have seen weaknesses. Now, earlier you mentioned the inflation expectations being 4.5% 1 year. This actually, not only is there a psychological component to it, that actually drives spending patterns. So going back to the third quarter GDP, where spending really knocked it out of the park, it actually happened with the savings rate going down and credit card balances going to record highs. So if you think that the price is going to be much higher down the road, you're going to spend today. And that is the enigma of inflation. And that is something that the Fed, I believe, is still fighting on. But certainly, this is not a look of a healthy consumer. This is a look of a very creative consumer who's trying to buy today instead of paying more tomorrow. And certainly in the holiday season, looking for bargains and value over a long period of time starting in October.
Anna, can you talk to us a bit about how this may or may not impact your overall investment strategy, right? Because the consumer, I feel like, has been sort of this persistent, resilient source of support, albeit more for services spending than for goods spending over the course of the last couple of years. As the consumer approaches this holiday season, how do you think that ultimately plays out in risk assets or risk-averse assets?
Well, it certainly is not the best picture for risk assets because, look, if prices are coming down because of a lot of bargains, that is definitely margin pressure. So this, for a lot of retailers, it's going to be a volume gain versus a margin gain, right? So that's not a really great place to be. And that has to do with all of the weaknesses that we've talked about as an investment community regarding liquidity of the American consumers. So we're a little bit shy on the risk assets. I know some people have said with the Fed potentially pausing forever on this rate hike cycle that maybe we've hit bottom. That is not our view. And certainly for risk averse assets, we just talked about rates picking up. At some point, we do believe there will be a rush to safe haven assets.
So let's talk about what that would be, what would sort of drive that. Because as you speak, if you're not betting against the consumer and they're buying what they can now, if you expect prices to be even higher later, that could actually fuel prices to be higher later, and it becomes a self-fulfilling cycle, which is exactly what the Fed has been talking about. You get that type of situation. What's the break point here? Why isn't that just going to continue with this positive momentum that some people have been surprised by repeatedly this year?
Well, the break point is that people run out of money. Right. And so what we're seeing slowly is a ticking up of some of the weaknesses there. Auto loans, credit card defaults, the delinquencies that are past 90 days are picking up and to levels that we haven't seen since 2011. Third-party collection amounts are at their highest. So we are definitely seeing stresses there. Something's going to break in that arena. So the consumers, I don't think we can go at this pace. Another thing is credit card balances being over $1 trillion in the aggregate. The interest rate on that is no longer what it was last year. Last year, it was around 15%. This year, it's over 20. So that's billions and billions of dollars that are going to be spent in paying interest rather than spending on the economy. So this is definitely not a scenario in which the American consumers can continue to spend the way they have been in 2023.
Anna Rathbun of CBIZ Investment Advisory Solutions, thank you so much for being with us. Have a wonderful Thanksgiving weekend. And honestly, Gina, this is sort of the conundrum. Everyone's been expecting the consumer to run out of cash. It hasn't.
Yeah.
And they keep on spending. And even now, some people are pointing to the fact that what if people are getting real incomes that are rising now because of disinflation? Won't that fuel their ability to do even more?
Right. And I think there's a lot of confusion, frankly, as to where we are in the cycle, because the consumer did react. They reacted pretty significantly in 2022. I don't know why no one really recognized it, but remember 2022, the summer of 2022, we were talking to Target and Walmart about major inventory problems because they had too much stuff. And the consumer was already pulling back when gas prices were exploding higher in the middle of 2022. So we did see retail sales correct somewhat in 2022. They just haven't corrected to the degree to which many had anticipated that they would, and have stabilized in 2023. And that's the real conundrum is, okay, so the consumer has already pulled back on their goods spending. They're not going to the retail stores as much as they had, but they're still spending on services. They're still going out there and they're still spending on those airlines. They're still spending on travel. They're still going to restaurants. That's where there is a potential for pullback here, in my opinion. And we haven't yet seen it with the degree to which the consumer can sustain that. The other thing that nobody's talking about is, okay, the consumer is maybe not running out of cash because they're getting paid for that cash suddenly.
Right.
So to the degree that they have some money in savings, they're actually making 5% a year on that money. Not zero.
Yeah,
that is a kind of a feel-good factor, frankly.
This is something that we will pick up on in just a second. If you are just joining the program, the S&P up just marginally, up about 0.1% throughout the morning. NASDAQ off just a touch, but quiet, really quiet. You are seeing a bit of a lift to the euro versus the dollar as you do get better than expected data, 109.23. To that point, Gina, and this is something that people have been arguing for, is there on the margins, not necessarily the base case, but on the margins, isn't there a stimulative effect of earning money on your cash?
I think there is.
Right. So the counterintuitive of, when you lower rates, it's stimulative. Well, actually, when you gain money from your money, you can go out and spend that money.
Yep. especially in an environment where less than half of overall wages and salaries is actually coming from jobs at this point in time. This is something nobody ever talks about. When you look at the overall bucket of disposable income, you get just a portion of that disposable income comes from wages and salaries. So we're somewhat dependent upon the job market, but not entirely dependent upon the job market. Consumers earning money on dividends, on their investments in homes, on their investments in cash, as well as just general retirees are a huge portion of this population that is not sensitive to what happens in the job market. They're more sensitive to how their investment strategy is playing out, and they're making money on their investments.
Can you just say that one more time?
Half of disposable income has nothing to do with wages, nothing to do with wages and salaries.
But this is something that is not talked about a lot and has pretty significant implications on the monetary impulse, as well as just how important the job market is. Coming up, we'll be talking about that. We'll also be talking about Black Friday, what they are seeing on the street. Joe Feldman of Telsey Advisories, he will be joining us coming up next.
We have seen the unemployment rate starting to rise, and that could be an early sign that things are slowing down. And it could be quick, when things do slow down. But yeah, so far the data have just been incredibly resilient.
Veronica Clark, economist at Citigroup, talking about why rates could stay higher for longer, and just again, why betting against the American consumer has been a failing proposition repeatedly over the past couple of years. We have gotten some spies out there in the stores looking around. We saw Macy's on the floor. It looked like there were some people there. Joining us to give us his review of the scene from White Plains, Joe Feldman, Senior Research Analyst and Assistant Director of Research at Telsey Advisory Group. This is sort of the tradition. You wake up early, I assume, and you go out to see what's going on in the different stores. Can you just give us a rundown of what your first take is this year?
Yeah, so I did get up early, as you said, part of the tradition, and it was very quiet out there. I was in a Best Buy and a Target so far. Not too many stores are open yet. Best Buy, Target, Dick's Sporting Goods were all open around 6 a.m., and the traffic is light. They're all ready for the Black Friday day. They're well stocked. The signage was great. A lot of employees in the store, just not a lot of people yet. And I think that's because you can get a lot of the goods and those prices earlier. I mean, you could have gotten it yesterday online. You could have gotten it the past week, really. At a lot of these stores, they started their Black Friday sales much earlier than we've seen in the past. And I think that's, just elongating the season, and also less of a rush to get out first thing in the morning for that doorbuster.
Joe, I want to really key in on this idea that many of the retailers are not open yet, because my recollection is over the last couple of years, we were extending the opening hours among retail. We had a lot of retailers even opening a few years ago on Thanksgiving as opposed to waiting to open early on Black Friday. What's the change here? Is it really just the overall extension of the season and the advent of online retail as a really critical component of our shopping strategy? Or is there a labor component to this? Is there something to do with lack of labor, lack of available labor, and also some pushback from labor as to what they're willing to do?
I think that's a great point, because I do think that labor isn't a component here, where, the retailers have decided that, look, given the volumes that they've seen in the past couple of years, and maybe it's better to treat their employees better, and, maybe not have everybody out at midnight on Black Friday, or even, at the end, 6 p.m. on Thanksgiving, like we saw several years ago, where the traffic into the stores just wasn't enough to warrant A, spending on the labor, and B, giving labor a break and giving the store employees a chance to rest and enjoy the holiday with their families, and then come in refreshed for the next day. I do think that by elongating the season, that helped alleviate some of that stress and puts less emphasis on just this Black Friday alone. I do think we're going to see a pretty decent day in the malls later and out in the stores, and for the whole weekend. But again, it's just a longer period that we're seeing.
Okay, so a decent day today, a decent weekend potentially. What does that mean for that longer period? What are you expecting for holiday sales? We had a pretty good conversation with Wells Fargo earlier this morning. They're looking at 5% retail sales growth, which frankly doesn't sound too bad, given long-term average pace of sales growth this time of year is about 4%. That sounds pretty decent, pretty optimistic. What are you at Telsey Group thinking?
Yeah, the 5% seems a little bit optimistic, but we've seen quite a few people with, estimates somewhere in that 3 to 5% area. At Telsey Advisory Group, our formal estimate is 3.5 to 4%. We did it two ways. We looked at it bottom up, just like looking at all the forecasts for the companies. We also looked at it top down, just looking at the macro data of all the U.S. government retail sales. 3.5, 4%. We felt like, as you said, that 4% or so is kind of the long-term average, and it feels like this is going to be a bit more of a normal year like that.
So, Joe, I got to be honest, the main topic of discussion at my household for Thanksgiving was generative AI and how it's going to transform our world. I know it sounds like a scintillating holiday discussion, but I'm curious from your vantage point.
Lisa has a particularly nerdy house.
100%. It's okay. I embrace it, but I'm curious, how much that's changing the way people shop. I mean, given the fact that a third of people, respondents to the survey that I was reading, are using some generative AI to figure out how to shop. I mean, how is this shifting the way that some of these companies really try to cater to their customers?
So I think the retailers are starting to embrace it. It still feels very early for it, though. And the quality of the generative AI, the responses you get is somewhat mixed. But the retailers are working aggressively to try to help, do things more efficiently for their own organizations and also serve the customer better. If you think about the chatbots that you get when you go online, or, maybe if the large language model generative AI have more natural responses and better quality responses. I think that's coming. It's not quite here yet, but people are embracing it. And I think that the retailers are all trying to get there. But it's really, I think, a couple of years away before we're going to see a major impact from it.
Although, if you take it a step further, Joe, there was something else, just sort of in the catastrophic realm of talk, which is also, it makes dinners really exciting. I'm curious about, what this means for the employment picture. We're talking about labor, and it's actually very much connected to what you were just talking about with Gina. You don't have to pay a robot to work during the holidays. How much is there this feeling of, cash registers that are self-checkout, different programs that can do personal shopping for you? I mean, there's an evolution to this that can really cut back some of the base costs for these retailers. How much are we seeing that in the stores at this point?
At this point, I think it's still relatively low because of that particular technology, generative AI. But I do think that we have seen technology reduce costs for retailers, make them run more efficiently. We've seen, as you mentioned, automated self-checkout. Or assisted self-checkout now. You can have one person manning 5 or 6 registers at the same time. It's a lot more efficient, and then you can get people onto the floor to help the customers. You can stock the aisles better. So there's a lot that you can do. And then on the back end, just on the supply chain side, there's so much you can do. Now, retailers have been embracing AI and machine learning for years. The generative part is where it's new, and that's still yet to come. And, my understanding is a lot of the retailers, they're still staffing up. They still need the people to even be able to harness it, and the data, the software engineers to really write the code and to really embrace it. And, I do think there's an important element here where people are so crucial to the system, because it does create those jobs for people, maybe more skilled labor on the software engineering side. Also, within the store, you still want customer-facing people. You still want people to help the customer. And so I think it just changes the tasks for labor within the store rather than necessarily cut labor too thin.
Joe, can we talk a little bit about the broader competitive landscape for a retailer right now? Because I'm struck by this idea that consumers are still very focused on experiences, on spending on services, on going to restaurants. How are retailers thinking about not just their competition with their fellow retail, but their general competition for consumer dollars in an environment where consumers are clearly preferring to go and spend on services relative to goods?
Yeah, I think the retailers are doing two things. One is they're trying to create a more exciting environment and more of an experience itself within the store, or if you're shopping online, have a more efficient experience, a better, fun experience, one of discovery, treasure hunt to some extent at some stores. The other part is innovation. Whenever we see innovation in products, whether it's apparel, furnishings or electronics, the consumer tends to respond. And so, when we have had that innovation, the consumer responds. We're trying to push innovation a bit more from the retail side. But I do think the retailers have been very prudent in their outlook, understanding that services spending is still, recovering actually from where, to get back to even pre-pandemic levels. So we're not fully there yet. So I think the assumption is that you will see continued spending on services. The retailers are just trying to find a way to create exciting merchandise to get people to buy that at the same time. And that's also why I think we're going to see a decent holiday season, because the consumer has money. They're just spending in different pockets right now. And I think that selective or choiceful spending, as some have said, is really where you can see that shift. Now the time is, the holiday season, gift giving. I think that's where you're going to see that shift back. Maybe come first quarter, winter, people want to get away. Travel starts to happen again with school breaks in the February, March time period.
Joe Feldman, thank you so much for being with us. Happy holidays. Joe Feldman of Telsey Advisory Group, thank you for being with us. I got to say, Gina, I'm not the best person to really talk about the sort of buying of stuff, because I'd be completely ascetic if I could. But there's sort of the question of how many people are sort of locked into homes that are smaller than what they need. They can't leave, so they don't want to buy more stuff to fill it. Right. I'm just saying, theoretically, that could be something going on.
No, I think that's really interesting. The other aspect is higher interest rates generally impact goods spending a lot more than they impact services spending. You get higher interest rates, you tend to finance a lot of these heavy durable goods purchases. You're less likely to do that when it costs you so much more.
Yeah, coming up, we're going to be speaking with Michael Purvis of Talbot and Advisory Group as we parse out what exactly retailers are doing on this Black Friday.
The holiday rally is certainly very much in force.
It's an environment where equities, are expensive, and wages are growing, corporate profits are okay, but everything is priced in.
The economy overall is still doing well. Less and less calls for a recession during 2024.
I don't think this ends in a soft landing. It's either a harder landing, or you're just stuck at too high inflation.
Certainly, I think we're going to be entering 2024 on a substantially weaker footing.
This is Bloomberg Surveillance with Tom Keene, Jonathan Ferro, and Lisa Abramowicz.
5 hours until the end of the trading day for stocks in the U.S. Not that any of us are counting. Welcome back. Good morning. This is Bloomberg Surveillance Live on Bloomberg Television and Radio. Tom Keene, Jonathan Ferro, and Lisa Abramowicz. Tom and John enjoying a very well-deserved day off. I am thankful for them. I am also very thankful to Gina Martin-Adams, who is here beside me on this post-Thanksgiving day, parsing through all of the retail glory that is the tradition on Black Friday. What are you looking for? I mean, how important is it to really understand this from a specific day point of view versus just sort of taking stock of where the consumer is?
I think it's one day in an overall season. Frankly, right now I'm watching inflation expectations as the more important indicator, because retail sales peaked all the way back in 2021. So we're looking at a consumer that's already done some adjusting to the higher interest rate environment. I think it's probably at this point a little bit more important to watch services spending. So how much they spend on travel to go see family, how much they spend at restaurants is also incredibly important. That said, obviously no one wants to see the consumer completely turn over here. So we need to see at least some degree of stability over the course of the fourth quarter at large. And Black Friday is clearly a key component of that.
What proportion do you think of U.S. workers in the financial sector are in the office today? At work?
Gosh, it's got to be. What do you think? Maybe 10%?
Maybe. I would guess probably less than that.
Yeah,
a lot of people working from home, and otherwise, I mean, it just feels like there's just this sort of, put it on auto trade if you need to, and trigger call my cell if you need me.
Absolutely. And I think there's very few people trading at all, even from their basement. On a day like today, the volume is going to be limited. Volatility will likely be interesting, but not what it normally is on an average trading day.
You pointed out the University of Michigan sentiment survey and how it came out with inflation expectations that were higher than expected. And we've been talking a lot about the cumulative inflation, and yet I do wonder where it's coming from. I'm really looking forward coming up at 8:45 a.m. Eastern, talking with Justin Wolfers about how there are a lot of sectors where prices are actually going down, where things are cheaper, and yet it's not really factoring into the way that people feel.
Yeah, you've brought up on a number of occasions housing prices and the cost of housing, the cost of rent, the cost of housing. saying is a key part of the consumer psychology with respect to inflation that doesn't typically get covered as a component of inflation. We all think about retail sales as sort of the primary proxy for what is the consumer doing, how is the consumer behaving, but that's really only a portion of the story. What are they doing with their houses? They're stuck in them. They're stuck in them at high prices. That's great for wealth, for those that own the houses. It's not great for the consumers who are thinking about getting into houses, and they see an endless price increase in their future.
Well, we are going to be speaking with Justin Wolfers, I'd correct myself, at 8:15 a.m., so just coming up. Right now, coming up in markets, you can see that quiet, that lack of engagement that we were talking about in a lack of action. The S&P futures basically going nowhere, up 0.05%, basically flat. We're looking at a bit of euro strength, although really, again, no drama. The real drama of today, and I would say if it is drama, would be the 10-year yield, 4.47% rounded up more than 6 basis points. We're talking about what's happening with the University of Michigan survey. We're also talking about Germany and the possibility of issuing more debt or allowing them to continue this issuance, not having to go back to net zero issuance or net zero addition to their debt pile. To me, that's interesting. It sort of speaks to this ongoing fiscal stimulus, regardless of the inflationary backdrop.
Yeah, and ongoing fiscal stimulus is generally perceived as quite inflationary, right? So it's contributing to the inflationary psychology that fiscal governments are or fiscal spending is unable to pull back in the environment that we're in, even though we're technically in recovery. There has been no recession declared. The fiscal expenditure is still enormously high, and a lot of question marks as to how we're going to pay for that fiscal expenditure. Once you get started spending, how do you cut it back, and how do you pay for it? Because we fund it via debt.
Yeah, and this is a reason why it's been so difficult to come up with any kind of forward-looking projections, which is why we're going to bring on Michael Purvis, Tal Beckett Advisors founder and CEO, to try to come up with some projections and way to shape how to think it's heading into the next year. I'm wondering with this holiday pause, if we are looking at a holiday rally that does have legs, but that leads to perhaps a reassessment come beginning of 2024.
Yeah, I mean, my working framework right now is that we will get a continuation of what we've seen and sort of the sprint to the year end. I think there's a lot of seasonal patterns at work. You know, if you go back, I went back to 1928 and you look at how if the market is up more than 10% coming into Q4, more often than not, the market is up nicely into year end. There was a couple of notable exceptions when that wasn't the case, 1929 and 1987. But putting those sort of very specific situations aside, you've got seasonals. But then, you know, coming into November, what did you really need to check the box for that bullish sprint? You needed stabilization in rates. You can check that box, at least for now. You needed a decent to pretty good earnings season, and you could check that box. There, on top of that, you've got the dollar strength has now kind of rolled over here. And that's softened the financial conditions, which are getting pretty stressed in October. So, yeah, I think there's a lot of flows coming into the markets into year end. You know, do we get to 4,700? I think that's certainly on the table. 4,800 seems like a stretch, but you never know. You can have some crazy stuff happening in December. With all that said, if we do get those levels, I think you're going to get a pretty reasonable hangover in January and February, where I would be advocating legging into protection, as the market climbs there. Because I think as we look forwards into 2024, I think one of the things is that I'm not particularly bearish on the markets or on the economy, but I think the expectation of soaring earnings growth and that upside surprise factor that we had this year is just not on the cards there. And I do think that there's some, definite evidence of that nominal GDP is going to be lower, and that's going to probably mean some of the earnings expectations, particularly in cyclical value, are not going to be quite as good as many expect right now.
Okay, Michael, so we're talking about a potentially poor start to 2024. What will that mean for the rest of the year? Do you expect those negative estimate revisions to play out just in the first quarter, and then we normalize into the latter parts of 2024, or is this the beginning of something a little bit more nefarious?
No, I don't think it's the beginning of anything more nefarious. I think probably the downside case is more of a range-bound equity condition next year, where we're sort of up and down and sideways as we're going through multiple sort of regime adjustments there. And on the earnings side, I'm not on that. I don't see a real recession here. What I do see is a low velocity degradation in growth from what we have known over the course of this summer here, and that's going to reflect in some earnings, and of course, the Magnificent Seven and the big tech earnings have less economic sensitivity, or classic economic sensitivity anyway. There, and I think that's a very important pillar of overall index earnings there, and I think that's going to probably be reasonably decent next year. So the question is I think bottoms up consensus for next year is compiled by Bloomberg. It's about 12% year-over-year earnings growth. I'm sort of coming out more at like sort of a 5, 6, 7% earnings growth number, and I think the markets will have to sort of ultimately adjust to that. And then, of course, there's what P do you want to pay for those that type of growth into next year as we sort of get into a lower nominal world.
What's the pain trade, Michael? And I ask this because that's what seems to play out every single year, is that we come up with a consensus, and then whatever you can imagine the biggest pain trade happening, that's what happens. So what is it this year?
Oh, this year meaning the
heading
rest of
into
this year?
2024. Yeah, heading into 2024.
Okay. Well, that's a good question. I think right now, I don't know if this is exactly pain trade, but I think a lot of people have thought that the Treasury sell-off on the back end is over. And I don't think it is. I think there's a lot of evidence to suggest that term premium is going to be, it sort of shot up, in September and October, and it retraced all that. And I think a lot of that was a function of very aggressive trading and positioning, closing out trades. But I think the broader theme here is that, if you look at the Fed's calculation of term premium, the ACM term premium, it went negative from like 2018 on, and then, this year it sort of started really coming back into positive territory. And now it's back down to zero-ish. I think what's happening here is global central banks are retreating from ultra-dovish central policies here. I think that's structural. I think that's going to continue at pace. We were just talking about Germany increasing supply. I think there's a supply condition that's only going to exacerbate term premium. And I think, could we get to, a 10-year back to 5 and maybe even 5.25? I think absolutely is one of those cases. So I think the worst is over for the back end of the Treasury curve. I think I'm not on that page, and I think there could be, sort of another move higher in the back end of the Treasury curve.
Michael Purvis, thank you so much for being with us, and happy holidays, happy Thanksgiving, happy
Thank
Black
you.
Friday. Michael Purvis of Talbot, and we appreciate that. Interesting that he is talking about that basically there's this pain trade of a stickier inflation and benchmark long-term yields that go up. And honestly, I've heard that from an increasing number of people with low conviction, right? Because we just don't know. But that would be pretty painful for both bonds as well as in stocks.
Yeah, stocks, guaranteed, stocks are not going to like it if the 10-year Treasury goes back above 5%. That move from 4 to 5 was incredibly painful in equities. I know that we tend to dismiss it because we've had a nice little bounce on the other side of that, but it was very, very difficult and entirely responsible for the equity meltdown that we saw in the third quarter of this year. So anything above 5 would certainly shock the equity market, and not in a good way, particularly as we're weakening a little bit in terms of the earnings outlook. We see the same as Michael in that estimate revision probably has to move a touch lower into earlier next year. If you have negative estimate revision at the same time as yields are going higher, that's going to be painful and create a lot of volatility.
Which maybe is what some people were hedged for and are getting squeezed out of that as it doesn't come to pass. If you are just joining the program, we are seeing a market that is quiet, as you would expect. We are seeing bonds yields go a bit higher, bond prices fall. You can either attribute that to what we saw over in Germany or what you saw with respect to the University of Michigan sentiment survey. S&P futures up about 0.1%, 45.71. But what you would bring up is a really interesting point, and I do wonder your vantage point here, Gina. One thing Tom talks about all the time is that inflation is actually really good for earnings.
Okay.
And that on a nominal level, you see more money coming in.
Yeah.
Doesn't matter whether it's on bigger volume sales or whatever. You're starting to see that around the margins with Deere, for example. Prices going down, and that was affecting their top line. How much is sticky inflation a bad thing for equities versus a good thing?
It is a sector and industry specific story because it depends upon where the inflation is coming from. In an environment where inflation was truly based upon supply constraints. Demand was holding up, but supply constraints were driving the inflation. Goods-centric industries that have to contend with inventory uncertainty are generally pressured most. In an environment where oil prices are surging higher, that again points to retailers as most likely to experience weakness in an environment where oil prices are surging. The inflation that we're having today is very different than the inflation that we were having a year and 2 years ago, in that inflation is potentially more embedded and potentially changing psychology, but not necessarily based upon supply chain constraints and weaknesses in the geopolitical environment. So I do think you have to be really careful about it. It's just not the same. Over the course of the equity market, we can't really paint it with one big brush. The fact that energy prices have come back a little bit is a big support to equities at large. But at the same time, you're seeing a lot of consumer companies suggest their net sales volumes are contracting or weakening here.
They are, however, traveling, and we will be speaking about that coming up later. But coming up now, Justin Wolfers, economics professor at the University of Michigan, breaking down the price of yesterday's Thanksgiving meal and kind of how this speaks into sentiment, where inflation matters most for people.
The economy overall is still doing well. Less and less calls for a recession during 2024. As long as we have that, real rates will stay high because that's the counterbalance to the economy doing well. So highest conviction trade is no eases. Fed on hold till at least after the election.
A very counter-consensus call from Earl Davis of BMO Global Asset Management last week. We were taking a look at how that is something that people call the pain trade. Michael Purvis just speaking with that as well. We are seeing in markets a very quiet day, really early close to the U.S. trading day. A lot of people are not in the office. You are seeing basically no movement on the S&P, giving back some of the earlier gains. But again, no drama. The big drama to me is that 10-year yields are up almost 7 basis points, 4.47% as people parse through whether you could see a stickier inflation, whether you are going to see more issuance globally in developed markets, and whether the Fed it might be done raising rates but aren't going to drop them anytime soon. We're also talking about what to make with your leftovers for Thanksgiving, including the money that you have left over after what we saw for Thanksgiving. Black Friday. Justin Wolfers, professor of economics at the University of Michigan, taking a look at Thanksgiving disinflation, saying, well, the cost of living is up and consumer perception is that everything is more expensive. The price of your holiday dinner actually fell from a year ago. The price of turkey down more than 5%, stuffing down almost 3%, cranberries down 18%. Pumpkin pie lovers, though, that price up almost 4%. I did make a pumpkin pie, and actually I did notice that. Justin joining us now. Justin, it's interesting that you put this out. It seems like, yes, it is interesting just on the face level of Thanksgiving, but there's a deeper message here about kind of where there is disinflation and how that isn't necessarily showing up in consumer sentiment. What's your take on that?
Lisa, I'm glad you saw the deeper message. Look, the deeper message was almost a form of performance art. I pretended to care about these individual prices. The reality is, if you want to track the cost of living, what you need to do is go and visit hundreds of supermarkets from dozens of cities and sample thousands of goods and have very sophisticated computers to put it all together. And thank goodness we have someone who does that for us called the BLS. And instead, what we get every year, and basically every news cycle, is some interest group or one side of the political spectrum or another will pretend to obsess and pretend to care about things like the price of turkeys. And actually, the graphic you just showed, I think, was a beautiful teaching point, because it's always the case that whether inflation's 2% or whether it's 4%, that there's a bunch of stuff going up a fair bit. And right there, you've got like, oh, that pumpkin pie mix. And I noticed bread rolls are a little bit more expensive too. And you've got a bunch of stuff going down, like the price of fresh cranberries. Turkey prices are plummeting because, the bird flu's a bit behind us. And so trying to tell the story of the whole economy through graphics like this, and I'm not having a go at Bloomberg because you were honest about it, Lisa, but often the major cable networks are not, is an absurd way of trying to track the macro economy. Let's focus on the data instead.
Justin, you correctly note that also airline costs are going down. So the cost of services is intriguingly going down year over year on top of the cost of goods going down In that kind of environment where we are seeing generally prices at least rationalizing from a sky-high pace of inflation over the last couple of years, why are consumers telling us that they're expecting more inflation going
Well, I think the simplest model of what's going through consumers' minds, they're not running sophisticated models of the form that you are or that your viewers might be. They're going to the store. And so generally, one of the best ways of predicting inflation is whatever's currently happening is going to continue to happen. And all the rest of the other stuff, what's going on with import prices or oil prices or the output gap, is just a slight modification of that. And consumers, of course, also are incredibly responsive to the most salient prices. The most salient prices obviously being gasoline, and I think beyond that, food. And so consumer inflation expectations tend to track those things a little bit too much. Now, the problem with this, of course, is what's not salient. Well, the cost of healthcare, the cost of education. But these things are a huge part of the consumer basket. The cost of housing as well. And so inflation expectations often, or perceptions, may not track reality particularly well at important points because we're a little bit too focused on what we see at the store and not what really matters.
So what do you think policymakers will focus on then, perceptions or reality?
Well, every policymaker I talk to gets told they should look at the darn data. Now, if you're talking about political policymakers, they've got two jobs. One is to figure out what's going on, and the other is to convince the electorate to re-elect them. Some of the genuinely silliest commentary we get on the economy, including and particularly on inflation, comes from congressional representatives, because they're always looking for the juiciest, least representative soundbite that helps their side the most. I worry that if you spend your whole time, all day, every day saying, for instance, Bidenflation has caused the price of dinner rolls to skyrocket, that you might eventually start to believe it. So I think those folks, I really do worry about their view on the economy. Now, I know Jay Powell and our friends at the Fed are a little more sophisticated. They're focusing on the real data. They've got folks poring over every line of those of the CPI, of the PCE, and so on. And I think they're telling pretty much the correct story, which is that inflation is moderating. There are good reasons to be optimistic it may moderate. One of the most notable things that has happened over the past year, really, is that Jay Powell has started to talk about inflation in terms of supply shocks. That's a real optimism that the bad times were due to supply and the supply shocks are behind us, which gives you a whole lot of reason to feel optimistic that the better times are ahead of us.
This sort of speaks to the whole immaculate disinflation idea, that it was just a supply shock right-siding itself and that there was this transitory, it's sort of back to transitory without saying the T word, which they were pilloried for. How much are we now starting to see demand side pick up for that, especially with real wages actually turning positive in a more material way with how much inflation's coming in?
Well, what really matters for inflation is what's going on with nominal wages. What matters for your quality of life is, of course, real wages. And nominal wage growth has been, fairly moderate, not far off what would normally be consistent with 2% inflation if you think about, inflation plus productivity. And I think now you've got to have inflation plus productivity plus a little bit of catch up for real wages having not kept up for all of that time. So, I see every reason to feel optimistic. There's a deep question here. The big question you just asked, Lisa, is this about supply or is it about demand? But actually on the supply side, is it just a bad supply shock exiting the system? Or maybe are we actually on the cusp of a positive supply shock? Are we seeing productivity rise at levels we haven't seen before? Are we seeing the economy expand without generating inflation? And we are. That might be what's going on with the immaculate disinflation. And you might say, hey, what caused this positive supply shock? And I'm going to tell you, Lisa, I've never seen a 3-year period in my entire history as an economist in which I saw this many businesses reorganize what they did. We reorganized the economy at a really fundamental level, everything from work from home to supply chains to global shipping routes. And maybe, just maybe, that's pushed back the frontier of what's possible. And I'm optimistic that's possible, but I think perhaps more interestingly for your viewers, I'm definitely hearing a sense from Jay Powell and the Fed that they're starting to believe that maybe is what's happened.
Are you going to be shopping today, Justin?
Well, I've got a phone and I've got 2 thumbs and I've got a really big wish list, so sure.
Well, good luck with all of that. Justin Wolfers, come back again. We love having you on. Justin Wolfers of the University of Michigan, thank you, and have a wonderful holiday. What he was saying there, Gina, fascinating to me. This idea that it is this sort of increase in productivity that people are kind of talking about on the margins, don't want to get too confident about, but that really this is the reason why we were talking about generative AI last night, how much that's the same game changer that the internet was, and how that's transforming things in real times in ways that we really can't quite fathom yet.
Yeah, and it's the next iteration after the pandemic really kicked off a whole adjustment in the business sector to a completely new reality, an adjustment in terms of their labor exposure, and adjustment in terms of their supply chains. And as he was talking, it really did strike me that when we're looking inside the profit stream for the S&P 500, we should be paying a lot more attention to productivity. Margins gave us the clue that we were going to see a pretty big dip in 2022, despite the fact that the economy seemed kind of fine, for lack of a more sophisticated word. So margins could be the really big story. If margins continue to improve, that's a reflection of those major shifts in business practices and productivity growth.
Yeah, I question how much people are more productive when they stay home. I'm just wondering. I don't know. I've seen a lot of studies in this, and it's controversial, and I don't know. I hear a lot of executives saying, come back to the office. Coming up, Anna Stupnitsky of Fidelity International as we parse through the holiday rally and what's to come after that. An hour to the start of trading day, we can see a bit of quiet across the board as people reset after a tremendous November rally. The biggest rally that we've had all year. We could look at the S&P up more than 8% so far just this month. I love the comment earlier this week. What a great year it's been for November, because that's sort of how it feels. Gina Martin Adams alongside me here today. But honestly, that's what it feels like. This was a tremendous rally that nobody was expecting.
Yeah, especially after things, the floor appeared to fall out for the S&P 500 as well as the Russell 2000. By the end of October, we were looking at really breaking through pretty critical resistant levels. But I guess you'd call this a classic technical oopsie, because all of a sudden we rallied right back up, proving those resistance levels to be new support. You know, I think this is fascinating just to see how rapidly things turned around. In
and
November.
how much we could have been looking at a very different projection for what to expect next year had we not had November, because it could have been the year-end targets for next year, which some people have been projecting, a 4,600.
Right. It puts all these equity strategists in quite a difficult position. And I have the privilege of being able to relate to that, given that it was my former life, where suddenly the prices surged to your 2024 year-end price target within the last 2 months of the year, because you get this nice seasonal lift. It creates a really tough outlook for the beginning of the next year.
So what do you do with that?
Yeah. Well, I think that most of us have some degree of fundamental models, right? And, you know, you migrate with the data. And if the data is proving to the case for a renewed sense of optimism, then so be it. If it's merely a technical correction and people are sort of jumping on board, it's sentiment based. And so you've got to balance the risks of sentiment versus what's truly happening with fundamentals.
Fundamentals really are driven also by consumer spending, which is the reason why Black Friday is taking on a particular importance this particular season. And earlier this morning, our own Caroline Hyde was speaking to Macy's CEO Jeff Gennett from their flagship store in New York City in Herald Square. She started by asking him about today's kickoff to the holiday shopping season.
We've got great deals, as we always do for Black Friday, going all the way through the holiday season. So we are ready. We've got all of our key items, you know, loaded to bear. Here we are in Herald Square. It was a good opening. We had a great day online yesterday during Thanksgiving.
I mean, you said that on your earnings, which were, about a week ago.
Yes.
That this gets earlier and earlier.
It does.
Black Friday, the competition. How important are the next few days and the run up to the holidays?
Oh, it's still very important. So, you know, when you think about kind of Black Friday deals really started right after Halloween is when they started. But this is still a pilgrimage. You've got, you know, America is traveling, and they are in homes, and they're coming into stores just like this one today. They're online. They've been online all the way through. So it's very, very important. So when we look at kind of Black Friday through Cyber Week, then we go into a lull. It's like 10 days where people kind of reset, and then those last 10 days become increasingly important. So it's one of the 3 stages right now that we are at the kind of the Christmas shopping is the one we're in right now, the first.
What, of course, your earnings showed so clearly is that it's about inventory management. management in many ways at the moment, and you've been managing to ace that. How are you ensuring you got the right thing at the right time for a consumer that basically we're all trying to understand right now?
So obviously the consumer's under pressure, but they still love gifts. And so we want to make sure that we've got all the right gifts and we've got all the right stock content in them. So I just walked this entire store to really understand where we are in all of the content across all of our categories, and we're in great shape. And that's really in tribute to the amount of work we've been putting in inventory control.
And when it comes to online versus in store, in retail, this is how you've been shifting the company. In particular, people aren't perhaps having the footfall in malls, they're coming to one-off stores, they're going to smaller store experiences, but e-commerce has just been the focus. How are you managing to be at the right time in the right place for an omni-channel purchaser?
So really, the strength of Macy's and Bloomingdale's and Bluemercury is that we're omni-channel and we're omni-category. So what you have is you have customers that are shopping online, they want to come into a store and try it on, and they maybe are transacting on the couch later that night. So the opportunity to make it as convenient for the customer as possible, however and whenever they want to shop. So that's our beauty, and doing that with a national footprint, with a great website, is what we depend on.
And of course, why you've got such a great bird's eye perspective, because you do have Bloomingdale's for the higher end, more luxury purchaser, and then more income breadth when it comes to Macy's. What are we seeing in terms of the consumer? Are they going to be spending more? Are they going to be pulling back?
So you do have customers that are under pressure. And so when you think about the inflation is still high, it's abating from the change of the inflation rate from last year, but it's still higher than it was last year. And customers have got a limited budget. Some of it is they're spending it in experiences and then in our discretionary categories. So we want to make sure that we've got the right price points across that entire spectrum. But you still give gifts. And this is where Macy's and Bloomingdale's and Bluemercury shine. So when you have this gift, somebody on your gift list, we're going to have the right content for you at the right price point. And we spend from when Black Friday ends to where we are right now. We've been spending a year getting ready for that. And we do trial runs on Valentine's Day, Mother's Day, Father's Day to make sure we've got the right gifts. We're ready.
That was Bloomberg's Caroline Hyde with Macy's CEO Jeff Gannett saying it's all about the gifts, and whatever it is, we are prepared for those holidays, which raises a question of how people can be so pessimistic. I mean, on one hand, you've got a lot of the executives who are going to argue for their case that people are going to keep spending. On the flip side, we have seen delinquency has been rising and this pullback around the margins, different kinds of outlooks that have been quite negative from the likes of Walmart. How do you put it together and come up with what we expect next year? Anna Stupnitska, global macroeconomist at Fidelity International, joining us now. And I want to start there because you're calling for a cyclical recession next year. What is that, especially in light of the fact that consumers are still spending and likely to continue doing so?
Hi, Lisa. Yes, cyclical recession is where growth slows down, but relatively modestly. So we do expect 2 or 3 quarters of negative growth, which is a recession, and then a steady recovery. So it's not a very deep recession, but nevertheless, a slowdown across the board. And this tightening that we have seen from the Fed is still working its way through the system. And we believe that the transmission mechanism is just delayed. And we are very close to the tipping point where we're starting to see more forceful transmission across the board, consumers and in the corporate sector in the US specifically. And that's why we think cyclical recession is the story for 24.
Anna, can you talk a little bit more about how that cyclical recession is comprised? And by that I mean, are you looking at, when you say across the board, are you looking at declines in consumption as well as fiscal investment, as well as business investment, as well as net exports? What is the composition of that deceleration? If it is indeed relatively light, where are the bigger risks versus the lesser risks?
Well, I think on the external side, it depends on the cycle, and a lot depends on China and emerging markets more generally and what demand does there. But domestically, we do expect a slowdown in consumer spending and some slowdown in investment. Also, support on the fiscal side is going to be much less than what we have seen this year. So yes, it's across the board, but where we think that the particular weakness might lie is in the corporate sector. As we know, the debt burden is very high, and those maturity walls are high in 24, yet high in 25, and that refinancing burden might lead to, or will lead to that weakness across the board within corporates.
And would you see that to be an international trend? For instance, clearly developed markets have some weak times ahead when it comes to refinancing. But is this also the case within the emerging market landscape?
This is more for the developed markets, and in Europe, this refinancing, this maturity walls are much higher, much steeper than in the US as we enter 24. And in fact, Europe is already approaching a recession. Germany is probably in recession, and the whole of the euro area is stagnating. And this is where we have seen, indeed, forceful transmission across the board. And the US will, to some extent, follow that sort of pattern, but later in 24. On the other hand, we think some emerging markets can still do relatively well in that environment, show that resilience. But as you know, a lot depends on the China cycle and how much policy support we'll see there.
Do you think the U.S. is still the sort of cleanest shirt in a dirty laundry bin, or whatever kind of analogy you want to put out there? Or do you think that it's going to shift away from the U.S.?
In terms of the growth,
opportunities,
drivers, where the opportunities. Yeah, I think again the global cycle has diverged to some extent. Has not been very in sync this year. As I said, Europe is already going into recession. The UK is probably there already. The US is probably still a few months away. And China is stabilizing. We're seeing that stabilization. And in fact, our base case for next year is what we call control stabilization. So just enough policy support to put the flow under the property market, just enough policy support to get consumption going there. And so that growth coming out from China, from emerging markets, can to some extent offset that slowdown, that recession that we're expecting in the developed world.
Anna Stupnitska of Fidelity International, thank you so much. Really appreciate you taking time, and have a wonderful weekend. We are looking at sort of these diverging fates of the different countries, to me, which I find fascinating, because some people were expecting Europe to actually outperform the U.S. to come out of this earlier. Now it seems like people aren't sure what to make of what. I mean, honestly, I'm not feeling any cohesion in the divergent story.
And remember, back in the days when we used to use the words global synchronization, synchronized recovery, synchronized recession, those are gone. Those words are over. We are in a completely different environment, especially because of what happened in 2022 when China shut down and the rest of the world started emerging. I think that's creating a lot of differentials in the cyclical story. There's also differentials for the more tech-exposed economies versus the less tech exposed, the tech producers of the world generally benefiting from this AI and CapEx wave. And then you've got the commodity producers of the world, which has probably been the biggest undercovered story of 2022, 2023. Commodity producers had a bang out growth year in 2022. They've had a real struggle in 2023. And that is a big fundamental shift when you look at underlying corporate earnings trends.
You, though, said something earlier that I thought was fascinating, which was that China might outperform in a more material way. And this might be the biggest surprise of 2024 because of just how underestimated it is. Where are the signs going to come from? Is this from consumer spending? Is this going to be from businesses reemerging and going back into China, getting faith that the policy is going to be consistent?
Yeah. So this is my pain trade. You asked someone else the pain trade. I think the pain trade of 2024 probably is upside out of China because expectations are so incredibly low. And it comes from a couple of different things starting to work together. The first really was signaled over the last week when finally President Biden and President Xi are actually talking. To have some talks emerge between the U.S. and China and positive potential talks for the first time really since 2018 is a huge potential benefit that we need to watch really carefully. So I think any sort of resolution of geopolitical tension will be really, really important. We still have to overcome the tech hurdle. There's a great desire on the part of both countries to be the tech leaders in the world. How will that resolve itself over time? But then thirdly, and you pointed this out earlier, the idea that China may come in and start to support support its property sector en masse may actually produce some domestic sort of stimulus over the course of next year is something to watch as well, to really reverse that psychology.
We seem to get a bit of that overnight. If you are just joining the program, we do see at least not a negative drag on the market ahead of the open, but really not much of anything. 45.68, everyone's still in bed. Tryptophan spurred naps that last longer than expected. 447.63 on the 10-year. This to me is what I'm watching. Yields up about 7 basis points, grinding higher throughout the morning. To me, that really is going to be the story, right? Is sort of how much are we going to see the glut of issuance that Germany, that the U.S., that the rest of the world is being forced to issue, including China.
Yeah.
Right? They were deleveraging. They're basically going to have to reverse that in some capacity if they really want to stimulate in a more material way. How much does that create kind of a sticking point, a headwind that does lead to these higher yields lasting for a bit longer?
Yeah, and ultimately, how much does it delay or restrain the potential growth on the part of the corporate sector as well? Because you think about the second derivative impact of fiscal governments having to really think about how they fund their debt is, we might have tax increases across the board. Will we have a reversal in tax? Will we see tax increases, corporate tax increases? We're already seeing in the U.S. specifically tax expense accelerate for corporates. It's something that we talked about a lot this fall that I feel is getting overlooked. We're going to have to fund this somehow. How much of it is going to get funded out of the private sector is a really important question.
We're also going to be talking about coming up the inflation of points that you might earn at different companies. I'm serious. This is actually a big theme of mine, is basically use your points now because they're probably going to be worth a lot less later on. I'm just saying, I'm going to check that, gut check that
Points
with Brian
inflation.
Kelly, founder of The Points Guy. That's coming up next.
We're seeing that more normalized travel pattern in the domestic market. I think what you're going to see internationally is increased capacity because that's where the demand was. So you'll see fares coming down, especially in the North Atlantic and the Caribbean, Mexico as well. Those are three of the biggest markets where we see declines.
That was Helene Becker, TD Cowen research analyst, focusing on the airline industry. Always wonderful to hear from her. And we are going to speak more about the travel plans everyone has, and it has been a very active travel season for this holiday, this Thanksgiving. I do want to first just go over a couple of stocks that are moving that are pretty interesting to me, including the maker of the Roomba device that will clean up after your Thanksgiving meal, and you could set it about your house to suck up all of the dust that all of your guests tracked in. Up 30%, not because people are going out to buy Roombas, but because Reuters is reporting that Amazon is set to win unconditional EU antitrust approval for its acquisition of this company, which raises this real question. So if John were here, he would say, I don't want that thing tracking all of my data and then transmitting it to Amazon. But it does raise questions about what exactly it's collecting as it goes around with all the dust.
Oh, this is a really good point, actually. But if he has an Alexa, he's already doing this. So,
he does have an Alexa, I know.
You know, it's hard to say whether or not. But, you know, it is a little bit freaky. This is something that came up at my Thanksgiving dinner, is how much when you're speaking about an issue, all of a sudden you get emails about that issue on your telephone. And maybe we haven't even given permission for this to happen. Maybe we have, but this is just another aspect of the tech companies taking over our lives.
Oh, the concept of what you can do with that data is definitely going to be fascinating. The application of artificial intelligence, but really it's the hardware that's captured everyone's attention. I also want to take a look at NVIDIA. Shares down about 1.6% after rising a bajillion percent so far this year. This comes after Reuters reporting that it told customers in China it's delaying the launch of a new artificial intelligence chip until the first quarter. To me, it's more interesting that it's down 0.6%. Basically, people just kind of shrugging. It's like, okay, I guess we can take profits for the moment into the holiday. Talking about taking profits, this is really an exciting conversation for me because I have been on a kick that if you don't spend your points now, you're going to lose them. And we've been point savers. Very much so when it comes to airlines, when it comes to hotels. You save them and you save them, you save them, and it feels good. But it doesn't really. Brian Kelly is here to explain why it's a terrible idea to do what I have done for so long. Founder of The Points Guy. Let's talk about points inflation. How real is it?
Well, Lisa, you're not a point saver, you're a points hoarder. And so many Americans are as well. You know, we get anxiety when it comes time to redeem them. It looks really nice to have a lot of points. But here, listen to me, everyone out there, use your points. You know, the airlines have officially become banks. You know, a lot of airlines are making more money selling their miles to credit card companies than they are by flying planes. which means there's more and more miles in the ecosystem, and the amount of miles it takes to travel is real. In fact, Southwest Airlines just announced in 2024, their points are going to be worth less when you redeem them. So key message, use your points now. Take that cold hard cash that you would have spent on the travel and put it towards other things.
I feel like I have to do some kind of, hi, my name is Lisa Abramowicz, and I'm a points hoarder. I would like to improve my standing in the world. Brian, how much are you seeing companies have to offer perks, have to offer something to really induce customers to come in, especially as you're starting to see discounts to airline prices and hotel prices, given people have traveled all they want, and now they're kind of pulling back a little bit?
Yeah, this is actually really good news for consumers, because I feel like for the last 3 years, every time I came on and did segments, it was bad news, rising airfare. Airfare at one point was raising 20% month over month, and we thought like 6 or 7% inflation was bad. So travelers have been hit the hardest. Finally, we're seeing a reprieve in those fares. And the airlines getting hit the worst are the budget, domestic carriers, because there's still huge demand for international. International airfares, especially in business and first class, are through the roof. It's domestically where the airlines are having trouble. And we're seeing, $111 fares to Puerto Rico this winter, $69 to Miami. 2 years ago, you couldn't fathom $69 to go to Miami. It was, as one of the top places to go. So there are good deals out there for consumers right now.
Brian, can you talk a little bit beyond airlines? Where are you seeing the greatest points deflation, I guess, as these points give you no benefit over time to hoard? Is it beyond airlines? Is it also car points, points for car rentals, points for hotels? And are there differences between those sectors?
Yeah, so car rental programs are pretty much useless. There's been so much consolidation there. There's only one or two main players. With car rental companies, it's more about the perks and getting elite status. So if you've got an Amex Platinum card, you may get elite status with, National or Hertz. So that's really where I would say, booking directly with car rental companies, it's all about recognition, not waiting in that line. The points are pretty meaningless. Hotels are actually pretty valuable. I would say World of Hyatt just won Best Loyalty Program at the Point Sky Awards. Hyatt's a great program. They've been acquiring more hotels, and they are a transfer partner of Chase. So that's the program that I like using the most. You can easily get 2 or 3 cents per point in value. But Marriott and Hilton are also pretty good programs. But here's my key tip when it comes to loyalty. Don't be loyal to a hotel or an airline. Be loyal to a credit card. The credit card companies are where it's at, because you can accrue points in Amex, Chase, or Bilt, and then you transfer them to a number of different partners. And this allows you to not just bank with one airline or hotel. It gives you a lot of different options when it comes time to redeem.
What about the credit cards that aren't giving you points necessarily to spend on travel, but for instance, Amazon's credit card, which gives you, credits to spend back at Amazon, or other credit card companies that give you points to spend at retail? How should we be approaching those points systems?
Yeah, if you want cash back, I recommend just getting a straight up cash back card. The Citi Double Cash basically gives 2% back, no annual fee. That's the gold standard. So instead of getting with one retailer that might have some wonky earning, and the Amazon card is pretty good actually for those who shop a lot at Amazon, but instead of just banking with one retailer, get an overall cash back card that gives you flexibility, because if you get cold hard cash, you can use it if you want travel or on anything else versus with just one retailer.
It strikes me that why should any company, why should a Delta, United, American try to cater to their loyal clients if this really is the business model, if it's really just about them being an arm, a loyalty arm tied to a credit card company?
Well, think about it. You might only fly a couple times a year, but you're using your co-branded credit card every single day. And that's where I think Delta in their recent earnings said 1% of total GDP spend in America is on a Delta co-branded Amex card. So think about that. Even that infrequent traveler, Delta's earning money when you go to the grocery store, when you pay for, all your expenses in your life. So it's a brilliant business model to bring people in, to give them these points, and then encourage them to fly on the airline, letting them board early. So, I will just say, while there's been devaluation in currencies, it costs more miles than ever before. You can also earn more miles, and the U.S. is very particular. You can get 100,000 point sign-up bonuses, earning 4x, 5x in certain categories. So, not all is lost. You just got to play the game correctly and use the credit cards that reward you where you're spending the most money.
What's the most extravagant trip you've ever taken using only points?
Well, I do love Emirates. Emirates first class on the A380 is an iconic experience. I took my parents on an around the world trip, and they've got a big onboard bar, and my dad and I were drinking, I think, $300 a glass.
Okay, Brian is my new hero.
We flew over the Himalayas, and it was like $200 out of pocket in taxes and fees. We were getting that first class experience cheaper than what people paid in coach, and that's why I love points.
Brian Kelly, founder of The Points Guy. We all aspire to be you. Brian, thank you so much for being with us, flying around the world with his parents, drinking $300 cocktails.
Amazing.
In Emirates Air. But to me, again, how much time, though, do you have to devote to knowing how to game out all the programs? I don't have the patience.
Well, if it's your business, you're the points guy. You got the time.
You get
to give us all the advice. What a great business.
Thank you so much for being with us today.
Oh, my pleasure.
I am grateful to you. I give thanks for Gina Martin.
Oh, my gosh. I give thanks to you as well. It's been a delight this morning.
What are you going to be doing for the rest of the year? How are you going to be looking for things to evolve?
It's very interesting because we actually run our own sort of recession model. It says that the U.S. economy is very, very weak already. So I'm actually looking for signs that things potentially stabilize into 2024 and we recover already. And then this is partially a function of the fact that I'm an eternal optimist, partially a function of the fact that I am an equity strategist, and equities tend to move first. But I'm looking for signs of a bottom finally forming in the economy as a result of this decelerating inflation pressure. But we'll see. We'll see what happens.
I love it. Thank you so much. We really appreciate it. Coming up on Bloomberg Television at 1 p.m. Eastern, Stephen Yalof, President and CEO of Tanger Factory Outlet Center. On this Black Friday, interesting to see whether it's going to be a good news story for people to be looking for discounts or a sign of caution as we head into the remainder of 2023. As we do, it is a quiescent day. People taking a breather after a pretty tumultuous couple of weeks.